time has come for policy to adjust.
We're more vulnerable to another negative data point on the labor market.
There's no question that growth is slowing, the labor market's slowing.
People have moved violently in terms of the narrative of the economy, in terms of what the Fed should do.
They really need to get a move on. I wish they'd started earlier.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Chairman Powell pouring some rocket fuel on equities on Friday. The time has come. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday with stocks just short of all-time highs on the S&P 500. Your scores look like this on the S&P. Futures slightly positive by about 0.1%. On the Nasdaq 100 up by 0.2. On the Russell, the small cap outperformance continues up by 0.6. The line of Jackson Hole and the annual get-together in Wyoming reads as follows. We do not seek or welcome further cooling in labor market conditions. Lisa, that was the big one.
And he added that the slowdown in the labor market was, quote, unmistakable. I'm glad that you started with that. This is the reason why, to me, the key data point economically this week will be the jobless claims on Thursday, more than even core PCE and income and spending on Friday. What we're looking at is a moment where maybe the data point dependence is not really happening, and yet any kind of shift in the perception of the labor market will quickly move the markets to believe a 50 basis point rate cut is in the offing next month.
We'd love your impression of how things went on Friday. I have to say, sitting around the table anticipating that speech, I was looking back to 2022, August 22, the speech about paying a single mandate central bank, so to speak, focused on getting inflation down, not really paying much attention to the labour market at all because it was very strong. And I think we all thought 2 years later we'd come back to this dual mandate with a focus on both inflation and the labour market. I think Mohamed El-Erian and the FT on Friday absolutely nailed it. A Fed that is still seen as a single mandate central bank, but with the crucial qualification that it is now focused on avoiding higher unemployment rather than lowering inflation. We've gone from one all the way to the other in 2 years.
And you felt that in terms of the words that Jay Powell used. Just a year ago, he was talking about inflation. This time he was talking labor market, labor force, labor conditions, et cetera. That was the preeminent concern. There is a feeling here, and this was the research that was presented there as well, that this is a Federal Reserve that needs to get ahead of material weakening. What they didn't talk about is almost as important as what they did talk about. They didn't talk about the neutral rate. They didn't talk about sacrificing the idea of a 2% target for some sort of labor market security. And that, I think, was the takeaway for a lot of people who really see that any downside surprise in the labor market is going to cause a real turbocharging of those rate cuts.
Elisa already called in jobless claims the data point of the week. She'll go through the week ahead in just a moment. You're going to hear a lot about September 6th on this programme this morning. The September 6th payrolls report for the month of August. The estimates so far, with 5 estimates in our survey at the moment, obviously that's going to build and this number might change, but 160 is the number at the moment. The median estimate in our survey, about 160. If you are just joining us, welcome to the programme. Let's start with equities. Futures at the moment look like this on the S&P 500. Just a little bit firmer. In the bond market, yields lower by a basis point or two, 378. More weak data out of Germany that we can talk about in just a moment. The euro, just a bit weaker. We're down 0.2%. Lisa, euro dollar, 111.72.
And we do get some inflation data out of Europe. I am actually very curious to see whether the ECB tries to match some of the expectations that we see from the Fed. More on that later. To me, really, the key will be the initial jobless claims on Thursday. The other key data point, obviously, is going to be Wednesday, NVIDIA reporting earnings. Who knew that earnings season went this late? A lot of people are kind of decrying that. The company has not missed estimates in the past 7 quarters. We do hear from Mary Daly today with her own Michael McKee in San Francisco. She couldn't make it to the Jackson Hole confab. And then, of course, on Friday, we do get those PCE data points, which is going to be important, although a lot of people already expect what it is, as well as ongoing spending and income for consumers. To me, really, John, the takeaway is going to be how much do we end up with this idea that, frankly, Rich Clarida of PIMCO, former vice chair, put well. Although the Fed likes to say it is data and not data point dependent, the August employment report, to your point, released on September 6th will likely be significant in the 25 versus 50 discussion at the next meeting.
Feels absolutely massive, and we'll get some answers to a few questions we've got on that in just a moment. Coming up on the programme, your lineup this hour looks like this. Peter Tchir of Academy on why he doesn't see a 50 basis point rate cut. Norman Roule of CSIS on mounting tensions in the Middle East. And Conrad Dequadros of Brean Capital on the Fed's muddled position. We begin with our top story. Stocks looking to build off 2 weeks of gains as traders assess the size and pace of rate cuts following Fed Chair Jay Powell's dovish pivot at Jackson Hole. Peter Tchir of Academy writing the following: since my preferred path was 25 or even 50 in July, with a pause in September, I should probably lean towards 50, but I cannot. Pete joins us now for more. Pete, how big is this September 6th payrolls report, and what's the difference between going 25 or 50?
One, I actually think ADP is going to take on a bit more meaning for markets. If you go back now after all the adjustments, ADP was probably a more accurate reflection of the labor market than anything we had on NFP. And, probably like a lot of other people, I'm wondering what would have happened or where would we be now on rates, markets, had we actually had accurate job numbers instead of having to revise them down by 815,000. But we are where we are, so we got to live with it. So I think people will take a little bit of a grain of salt in the August data that comes out September 6th. I think we'll watch ADP. We're going to watch JOLTS. I think people are really trying to figure out what is the state of the labor. And I think it's going to take a little bit more weakness or materially more to push the Fed to 50. They've been slow to move. Yes, he pivoted, but I think 25 is probably what we get unless we get almost negative payrolls this week or next week.
I'd love your thoughts on how we'd respond to good data versus bad based on what you just said. Are we more inclined to put more weight on weak data here and ignore strength?
I think we are. I think if we get strong payroll data, we're definitely not going to zero in terms of rate cuts, right? We're 25s locked in. I think if we get a really strong payroll, everyone will kind of, what's wrong with this data? It's all going to get revised down. So I think we're more susceptible to a weak, print. I do think people are going to, again, look at the JOLTS, try and divine more information from JOLTS, the quits rate, the hires rate, kind of that detail. They're going to look at ADP, even jobless claims, which I always view as kind of a secondary order data effect. People are going to look at more because we just can't trust that establishment headline the day it comes out anymore.
Peter, I love that you go to ADP because a lot of people always say, how do we even read this? And you're saying it might be more accurate than the establishment survey. Michael Darda of Roth MKM over the weekend came out with a note pointing out that typically when the Fed started cutting rates, it was pretty negative for risk assets. Historically, that's pretty much been the consistent theme. Do you think that this market is underpricing the risk, that it might not be as positive as the Fed is hoping?
Yeah, I think we've become a little bit too conditioned to lower rates automatically good for stocks. And to me, the big case is going to be, and we wrote about the Fed plodding along. So my view is that the Fed is going to be slow to respond to market conditions. I think that happened in July. We're back to all-time highs. But if that continues, right, we're now pricing in 8 cuts in the next 8 meetings. That seems too optimistic from the Fed, unless the data is so awful. So I think risk assets are a little bit susceptible. But to me, risk assets are going to be determined, 1, by NVIDIA. That's going to be a huge earnings report. And 2, if you look last week, we had all this chop back and forth. 0.5% moves were kind of like happening like that. 1% moves up, down, all around. And I think we are really at the mercy of algos, quant funds, zero data expiration options. And more people are talking about the rebalancing of these leveraged ETFs. And there's more and more single name leveraged ETFs. The market's kind of sloppy to trade, I think, right now because of that.
Peter, before we go to NVIDIA and the earnings on Wednesday, I want to go to this. I read your note over the weekend, and I was thinking when the people are away, the algos will play. And there's this question of what the consequence of some of this choppiness, this lack of liquidity, as you were talking about, really is. Is there a bigger systemic type of consequence to the chop that we're seeing that's expected to continue?
I think what we saw in early part of August is what we're going to start seeing more and more of is these kind of gradual, and I guess better than gradual, right? Fairly rapid moves higher, but really rapid moves lower. And I think you're going to have to play around that. If you're trying to position your portfolio, risk management, I think you're in an era where take some profits, take some chips off the table as it's doing well, as we kind of went from everyone so bearish to everyone so bullish. Because these downside moves, I think, are going to be sharp, dramatic, and they're very accentuated by this leveraged ETF rebalancing, by the zero data expiration options, this complete lack of liquidity. So that's my gameplay right now is very relatively small position size, take chips off the table, and set up for these rapid downside moves, because if you're not prepared for them, you cannot catch them.
Pete, give us some more detail on that. So let's talk about where leadership has been over the last week. Small caps, regional banks up by more than 5% in the past week. When you say take some chips off the table, are you talking about those pockets of the market?
No, in fact, you're right. I think you want to take the chips off the table in the NASDAQ 100. That's where a lot of the growth had been. And I am now comfortable. I like the banking sector. I think you're seeing that. I think you're starting to see the Russell 2000 do well. I could see commercial real estate doing well in here. So I'm looking for companies that been kind of left behind, right? This has been for at least a year or probably longer. Momentum has been the one factor that has worked really well. And I think we might have the case to see momentum start building in these Russell 2000 type stocks if that momentum starts developing, and not like a 2-day move like we saw last month, something a little bit more sustained. You start driving the momentum money in there. And given the nature of the market cap of these, I think you could see a really nice run into small caps and the banks.
Can we talk about the other side of that story? Wednesday, we do get NVIDIA earnings, and the expectation based into options is something like a 9% move on the heels of that. We've had 7 straight quarters where they've outperformed, upgraded their forecasts. How vulnerable is this market, given how big it is, how dominant it is in the indexes, to some sort of downside surprise?
I think it's definitely more susceptible to a downside move than an upside. Yes, it's great. Stocks off its high. It can still go much higher. But I do feel like there's selling pressure. People are kind of selling into some rallies now. People are questioning longer term. If you get a downside move, I think it could be pretty aggressive, and it will impact the indices, right? I think everyone now, we're really having to try and adjust how we think about passive, right? When 50% of these indices are 5 to 15 names, right? That's too much. So they don't behave as passive. So any outflows from the market because of one stock have a rapid ripple effect, which again is why I think you're safer in the Russell 2000 right now, because it would not be as impacted by that sort of ripple effect.
Pete, before you go, one final question. Can we ignore dollar yen now?
I think that was overstated how much people were paying attention to. I think you want to keep an eye on it. Maybe if it breaks through, down below 140, it becomes an issue again. But again, I felt like at the time that was, like the boogeyman. Everyone was talking about it. I don't think it was as prevalent as it was. So to me, though, this is much more still about the AI story and the economy and how bad or good jobs are and how quickly the Fed can respond. So I'm not paying that much attention to the yen.
Got it. Peter Tchir of Academy. Not alone, seemingly, based on the price action of Friday. Certainly not the boogeyman on Friday. At least the dollar yen down 1.3% in Friday's session. We're down to the low 140s now.
We saw a massive sell-off in the dollar. It caused George Saravelis over at Deutsche Bank to rethink his strong dollar call, considering the fact that there are very few catalysts that people see. And yet that has not been disruptive to the risk trade. And that really signals maybe we have shifted out of this yen carry trade unwind, although some people are talking about the revival in other pockets. But, the boogeyman can always come back.
We'll see. For now, just a pure observation. A bit more yen strength, 144 against the dollar. And equity's still doing OK, up by 0.2% on the S&P. Let's take the opportunity to get you some stories from elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes.
Hi, John. China and the Philippines are trading blame after a Chinese Coast Guard ship collided with a Philippine vessel in a disputed area of the South China Sea. Manila claims its vessel was subject to, quote, aggressive and dangerous maneuvers from 8 Chinese ships, saying they rammed into its ship and fired water cannons. The incident is the latest in a series that has fueled tensions between the two nations. Meanwhile, Bitcoin touching $65,000 for the first time in about 3 weeks earlier today before pulling back. The rally triggered by growing demand for Bitcoin ETFs as the Federal Reserve signals it's ready to loosen monetary policy. The cryptocurrency advanced more than 7% last week. That's the sharpest increase in a week since mid-July. And Boeing facing questions over the future of its Starliner program after NASA turned to SpaceX to return 2 astronauts stuck on the International Space Station. NASA announced the decision after weeks of testing and debate over Boeing's faulty spacecraft. The astronauts will stay at the ISS for about 6 more months before flying home in February on SpaceX's Crew 9 vehicle. The test flight was originally intended to last about 9 days. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. We'll catch up with Guy Johnson out of London in the next hour on this programme. I can't believe the story's not bigger. 2 astronauts stuck in space were meant to be there for 9 days. They're going to be there for months, see you in 2025.
Yeah, can you imagine? Can you imagine being one of them if they thought that they were going to come home next month? And it's like, just kidding. Just stay up there until February.
Just see my face when a flight gets delayed by about 2 hours.
Actually,
so never mind, 30 minutes. 30-minute delays.
I think that maybe that wasn't in your offing in terms of your career choices. Yeah, exactly.
Absolutely. They don't want me in NASA.
There's more to that story, though, too. It's really interesting.
We'll talk about it. Up next on the programme, finding attack lines that stick.
All the while, he intends to enact what in effect is a national sales tax, call it a Trump tax.
There's this whole thing that Kamala Harris did at the convention where she made a bunch of claims about what would happen and not enough actually reflection on what already happened.
That conversation up next, live from New York City this morning. Good morning. 2 weeks of gains on the S&P 500. Can we make it week 3? Here's the start. Equity futures this morning up by 0.2%. Yields lower by, let's call it a single basis point on the 10-year, 378.57. Under surveillance this morning, finding attack lines that stick.
All the while, he intends to enact what in effect is a national sales tax, call it a Trump tax.
There's this whole thing that Kamala Harris did at the convention where she made a bunch of claims about what would happen and not enough actually reflection on what already happened, right? Because Donald Trump was already president. He used tariffs to bring manufacturing jobs back to our country, and I think he'll do it again.
So here's the latest. Republicans framing their attack lines as the political focus shifts to the first presidential debate on September 10. Terry Haines of Pangea Policy writing this. The debate and the run-up to it very likely defines the race. Trump's goal in this quiet period is obvious. It's his turn to play spaghetti politics and find attack lines that land and allow him to gain some momentum. Terry joins us now for more. Terry, let's start with September 10th. There's a bit of tension emerging between the Trump campaign and ABC News and a question mark as to whether that's actually going to happen at all. What's your reaction to that?
Oh, I think it probably still does, John. You got a situation at bottom where Trump withdraws from the debate based on some real or imagined slight by the news network. He looks like he's pulling out and won't want to face Harris. So I don't think that's the case at all.
It's a big event for both of them to really define each other, or at least attempt to, Terry. Talk to me about your base case at the moment, how things have changed for you in the last couple of weeks.
Well, my base case is that Harris, I think, is about 60% likely to become president. I think the momentum, the aspirationalness of the thing, and frankly, the appeal of the new as opposed to the kind of dreary last decade that we've had. I think that's how voters are increasingly looking at it. I think that really kind of carries her, and you see Trump on the defensive, not really able to land a lot of punches. In your lead-in, Vance makes my point. He spends 30 seconds talking about the mechanism of how you should see this race, rather than making a case on policy specifics. If you have to argue the chairs on the Titanic deck, you're losing.
If they're trying to make an argument on policy specifics, they probably are just having trouble doing so, though, because we haven't really gotten policy specifics. That's been one of the criticisms, that, frankly, this is a vibe-driven type of campaign, and it really isn't heavy in any details of policy. Is that landing with undecided voters?
I don't think that matters to undecided voters. Undecided voters, by and large, care about what the candidate says that he or she is going to do. They're not really interested in the policy superstructure underneath or the specifics of any of that. They care about priorities. They care about results. And if they think that the candidate can deliver those, that's good for the candidate.
What's striking to me, Terry, is when I was wondering over the weekend and I was listening to both sides kind of trying to frame the arguments and thinking about whether this could be an entirely vibe-driven election cycle, you point out that it's likely that 1/2 or more of the POTUS ballots get cast early. 69% of voters nationwide cast their ballot non-traditionally by mail and or before Election Day. How many people do you think are going to cast this ballot before anything materially changes, potentially even before that September 10th debate?
Well, right. There will be a big rush to do that. And both parties, but particularly Democrats, have structures in place to try to encourage that. You're absolutely right. I mean, that the statistics that I cited were from the Census Bureau. And even if you knock off a little for the fact that 2020 was the big COVID year, let's just say roughly half of those votes get cast early and in a non-traditional, meaning by mail sort of sense. And, what you've got is a situation where, the vibiness around the Harris election can turn into votes pretty early. And that's exactly what the Democrats want to do.
Terry, for anyone familiar with the polling, what you'll see is a head-to-head number, and then you'll see a number that includes third-party candidates. RFK has stepped out. Terry, what's your sense of how that will influence the numbers in the polling in the weeks to come?
Two things. One is I said right out of the box, I thought that Kennedy leaving the race wasn't going to make much of a difference. His numbers went way through the floor over the past couple of months, and that was something that I anticipated. But my assumption is, and I'll be interested to see the polling, my assumption is that a lot of those people went home to Harris. firstly. So secondly, anybody that ends up going to Trump doesn't give Trump a particular bump. It's, kind of righting the ship a little bit to compensate for the people that already went home to Harris. Secondly, I think Kennedy is in a situation where even in the swing states, he doesn't bring a lot. Other pollsters who have been looking at this, Nate Silver, for example, showed that there was something like 0.3% that go to Trump. So not a big number. Thirdly, I would just say parenthetically about the polls, we haven't had a poll that registered public opinion since the 21st. A week ago. So we're waiting for the Harris kind of bump polls, number one. Number two, what we're waiting for is likely voter rather than registered voter polls, which will give us a more distilled idea of where the electorate actually is.
Still waiting for a sit-down interview as well, Terry. Do you remember the words of the vice president that she'd talk to her team and get something scheduled before the end of the month? What's happened with that?
Well, I think they'll dodge that as long as they can. They will do the things that they need to do that check the box of a live interview and are as controllable as possible. And so that probably means a friendlier network than, say, Bloomberg, for example. But you're in a situation where, she's not going to want to be asked a lot of hard questions. She doesn't have to answer a lot of hard questions, and she won't, so she won't want to, and she won't have to. And it's pretty much the end of it, I think.
I want to finish up with something that feels like it's out of left field, but it kind of wasn't. And we were talking about the sort of SpaceX question over the weekend that arose that the NASA astronauts are going to be taken back by a SpaceX spacecraft rather than a Boeing one. This comes at a time where Kamala Harris is actually in charge of the space program. How do you view some of the policy decisions, like dodging any potential accident through an election lens at a time where any misstep, any sort of exogenous type of development could derail some of the vibes that we're feeling that they seem to be trying to ride?
Yeah, I don't think that's out of left field at all. The competence of the federal government ought to be a much bigger issue than it is for no matter who's in charge of it at a particular time. That's a double-edged sword, by the way. You can go back to COVID and to say anything you want about COVID or Dr. Fauci or anything else, and Trump was the president at the time, so this can be prosecuted both ways. But the competence of the federal government is a significant problem. Harris shares some culpability for that, as you point out. But I think she's going to dodge it by and large because, people other than her, bureaucrats, are going to be seen as the decision makers and all that.
Are we not friendly, Terry? That's all I want to know. Are we not friendly?
Oh, when I said that, I thought it was.
You don't like us? We're not.
You all will prosecute that fairly and without fear or favor.
We'd ask actual questions, Terry, which is probably why that interview won't happen anytime soon.
Well, there's that, yes.
Terry Haines of Pangea Policy. Terry, thank you, sir. Appreciate it. I've got a policy suggestion for everyone, and you let me know if you're on board with this. It's fantastic. It's legislation that's just come into effect in Australia. Australians can now legally ignore unreasonable after-hours work calls and emails under this new legislation. Under the laws, employers face fines of up to $63,000 for getting in touch with an employee for non-essential reasons outside of working hours. You in?
Sure. I want to understand.
It's pretty punchy, right?
I want to understand what is non-essential. What is essential, right?
Sure.
I mean, at what point could someone just say that was non-essential? Please pay me $63,000.
I'm waiting for the courts to kind of start working through this.
Yeah.
But I imagine it's going to happen pretty quickly. You're going to get that first phone call or email and say, nope, and then call your lawyer.
Yeah, I actually would like to see how this gets carried out, because I would like to see in practice the due process of reasonable versus unreasonable.
Who's on board with that legislation? Coming up on the programme. Tensions mounting in the Middle East as Israel takes out thousands of missile launchers in Lebanon. The latest on that story out of the region with Jemana Betsy, and the latest reaction from Norman Roule of CSIS. The right to disconnect. The Australian Prime Minister, these words I imagine are very popular. For many Australians, I think they're getting frustrated that they're expected to be on their phones, their emails, all of that for 24 hours a day. The Australian PM said it's a mental health issue, frankly.
I think a lot of people would agree. There is a balance between efficiency and quality of life. And getting that balance correct is the right way to go. And the question is, how do you achieve that balance?
How does this work on Wall Street?
Well, I'm trying to get there in a diplomatic way.
Give me a break.
Well, I mean, exactly. What business would want to run somewhere where they have to, pay $63,000 if they message someone and say, hey, what about that deal? I think it's coming up for, expiration today.
Just doesn't work in practice, does it?
But that's a thing, and it's efficiency, it's a lot of things. But at the same time,
it sort of like politically pandering to the electorate as well?
I'm not going to be so skeptical. I'm not like that.
It's not about buying votes, winning votes. Up by 0.2 on the S&P 500. Scores look like this.
Thank you.
Futures with a lift. Lisa's got things to say about crude in just a moment. We'll get to it in a second. The Nasdaq up by 0.2%. The Nasdaq 100, a third week of gains last week. For the first time since June. It's been a while. In the bond market, front end of the curve where all the action is, a double-digit basis point move in last week's sessions. The 2-year down to 389.35. We're down by about 2 basis points on a session. On a 10-year down by, let's call it half a basis point today to 379.33. At least the whole curve, 2s out to 30s just dropping, particularly following the words from Chairman Powell.
What was notable to me was that Fed Chair Jay Powell was notably dovish, even versus expectations. He didn't seem to talk about measured in terms of the pace of rate cuts. He seemed to open the door to bigger rate cuts down the pike. And frankly, one conversation that I thought was particularly telling was with Loretta Mester, the former Cleveland Fed president, who said they might not start with a 25 basis point rate cut. They probably won't. But that doesn't mean that they won't go to a 50 basis point one at the next meeting. They don't want to start big. That doesn't mean they're not going to go big. And that, I think, is what the market is starting to price in.
You nailed it. They've said they're not data point dependent, but ultimately this whole conversation about 25 versus 50 is data point dependent. It comes down to one data point. September 6th payrolls. Most people agree with that.
Although I think that Peter Tchir was correct when he said that the bar is pretty high. And this is something that we heard also from Patrick Harker of the Philadelphia Fed, where he was saying that 25 is probably it, because they don't want to move the markets even more. But again, that goes to this question of, are they then going to signal a 50 basis point at the next one? Are they basically going to do it anyway, right? I mean, what are we actually talking about? And to this degree, I mean, Tom was...
What are we talking about?
Well, Tom was very dismissive. He was saying to me, people talk about 25 or 50, who cares? Like, it's... And on one hand, right. But if they go 50, the market's going to price in 200. And if they go 25, the market will stay where it is. And that, I think, is what they want to get to.
I've got a question for later in the programme. Who was speaking on Friday? Was that the Federal Reserve Chairman, his own opinion, or was he reflecting the consensus on the committee? Who was speaking on Friday?
That's a great question. And we do have Betsy Duke, a former Federal Reserve governor, coming up. And she said, interesting that he said, my confidence, while the rest of the comments reflected the FOMC actions and judgments. It's a great question and one that we can ask her.
It just sounded like there was some daylight between him and the other Fed officials we heard going into that speech. So that's the equity market, the bond market. Let's finish on the commodity market. Crude with a bit of a pop in the last 30 minutes or so. Back through 80 on Brent. Lisa, $80.75.
OK, there was this headline that caught my attention that the Libya Eastern government says that it will stop all oil production and exports. This is the reason why you saw oil pop. This is a debate over, frankly, government rule. This is the central bank governor who is being threatened to be pushed out of office in the region. And in response, he is shutting down crude. To me, it just highlights that we're all so focused on what happens with Lebanon, with Iran, with Israel. But it's not like the rest of the world is quiescent. It's not as though the rest of the world just is completely quiet. There's some real kind of struggles there. And you're seeing that percolate this morning.
Crude up across the board, Brent and WTI by something like 2 percentage points. One to watch, keep on the radar throughout the session this morning. Under surveillance this morning, Fed Chair Jay Powell's dovish pivot at Jackson Hole, leaving traders assessing the size and pace of potential rate cuts. We'll hear from Atlanta Fed President Raphael Bostic later this week, as well as the San Francisco Fed President Mary Daly sitting down with Bloomberg's Michael McKee at 2 p.m. Eastern Time. We'll see how much distance, daylight there is between Chairman Powell and the rest of the committee a little bit later on. Let's turn to this story. We mentioned it a little bit earlier. NASA announcing it won't send astronauts home from the International Space Station on Boeing's Starliner, instead tapping Elon Musk's SpaceX to handle the mission. The recovery is slated to launch in late September, which would have the astronauts back on US soil in February, months later than initially planned. What an embarrassing moment for Boeing.
And it comes after they already have posted billions of dollars of losses tied to all sorts of snafus and hiccups in their space program. A real question now, soul searching for the new CEO, who's coming into a whole host of problems. Does he jettison the space program? Because at this point, is it more trouble than it's worth? And how much does the U.S. government want to foster some sort of competitive process to ensure that there aren't the same kind of glitches and issues that keep astronauts in space for 6 months longer?
What do you make of them tapping SpaceX? What a win for Musk, eh?
It's a win for Musk, and it's coming from an administration that's had some tense relations with him. And I wonder how much he'll view this as sort of an olive branch to him. I don't know if I'm reading too much into this. I will just say that this is me purely reading through this, and that was my first thought. I will say, though, it highlights how they're going to safety above any type of allegiance or desired outcome, because what they want to avoid is some sort of loss of a crew, which would be catastrophic for them, both politically and just on a human level. And that is what they really are putting first.
More on Boeing a little bit later on this morning. Guy Johnson out of London joining us in about 60 minutes time. Let's turn to tensions mounting in the Middle East. Israel taking out thousands of Hezbollah missile launchers in what it's calling a preemptive strike, saying Hezbollah was about to fire thousands of missiles at northern Israel. Jamala joins us now out of the region, Bloomberg's very own. Jamala, let's get to this story. What is the latest, and what was your reaction to the news over the weekend?
Look, the way I've been describing this, Don and Lisa, is a de-escalatory escalation. We knew for a couple of weeks now that Hezbollah had been planning retaliation for the killing of its senior commander, end of July, Fuad Shukr. They had mentioned many times in the course of the last couple of weeks that a retaliation, a revenge strike was forthcoming. And the question was what shape or format that was going to take. Were Hezbollah going to act unilaterally? Were they going to go alongside other Iranian proxies in the region? Were Iran going to participate as well? Well, we got the answer this weekend. And what we saw was, in fact, quite a limited and calculated response. In the end, Hezbollah did act alone. Israel managed to intercept many of the rockets that potentially could have got fired. Israel saying that they intercepted thousands of rockets that were going to be directed towards central Israel. But Hezbollah themselves said that they managed to successfully launch more than 340 Katyusha rockets. But in the end, it didn't sustain a lot of damage. There was one life lost on the back of it, but they did not target any civilians. It was limited in terms of objective and nature, but from their perspective, they're presenting it as a victory of some sorts. And later in the afternoon yesterday, we got comments from the Secretary General Hassan Nasrallah saying that phase one of the retaliation was over. They're in wait-and-see mode to assess whether or not they need to do more. But his message to the Lebanese people is, you can relax now, which is very strange wording, given everything that has gone on in the border in the last couple of months. And I should say, from Israel's perspective, they did declare a 48-hour state of emergency. But by the end of the day, the Tel Aviv stock market was actually up on the day. So it does tell you that there is a little bit of a sense of relief that this wasn't worse, or that it was a more broader engagement from the region.
This is the reason why, Jumana, I was sort of surprised that some of the headlines this morning were threats of an escalation rock the Middle East. Was this an escalation or a de-escalation?
Yeah, I mean, that's why I've been calling it a de-escalatory escalation, because we knew that a retaliation was coming. But the other big question that people still have, of course, is what Iran do from here, because let's not forget that the same evening that the Hezbollah commander was killed, you also had the assassination of Ismail Haniyeh take place in Tehran. It was a very embarrassing event for Iranian security, and they have since vowed to retaliate in some shape or format as well. Interesting to hear from the Iranian foreign minister this morning. He was saying that if they do respond, it will be definite and calculated, but they are not seeking to increase tensions. And I think this is the operative word here. It does not seem like Iran want to get dragged into a bigger war. And that is one of the reasons why the region, at least right now, seems to have calmed down just a couple of notches from that heightened sense of alert that it's been on the last couple of weeks.
Somewhat counterintuitive, but just brilliant framing as always. Jumana out of the region in Dubai this morning. Let's cross over to Norm and Roule of CSIS. Norm, I think Lisa asked the right question, and Jumana gave us the framing to answer it. Would you agree with that? Was this an escalation or a de-escalation?
Good morning. It was certainly an escalation. Anytime you have 100 Israeli aircraft flying over Lebanon and 300 rockets fired into Israel, in normal times, that would be an extraordinary event. It has been de-escalated because each party does not seek a conventional war. And the rhetoric, even the nature of the strikes, which were limited to military sites in Israel from Hezbollah and southern Lebanon, shows that each side is not trying to turn this into a conventional conflict. But even that is consistent with how this entire conflict has been maintained since October. No one is looking for a war. Iran and its proxies have many reasons to continue their attacks on Israel.
I guess another way of asking this, Norm, would be, does this increase or decrease the chances of a ceasefire?
It has no impact on the ceasefire. The ceasefire is going to be an issue between Yahya Sinwar, who has very little reason to release hostages since it impacts his survival, and Benjamin Netanyahu, who has been repeatedly criticized by his own security establishment for not making the hostages as great a priority as the destruction of the Hamas. There is no public evidence that the ceasefire talks will succeed, although diplomacy works best in quiet, and there could be reasons for optimism that are not yet made public.
There also is this bigger question about what the significance of whether the U.S. has influence over Israel anymore, the degree to which it does have influence over Israel actually is. There was some suggestion that the U.S. was not aware of what was about to take place, was not a participant, and then had to respond by sending military craft to the region. What do you make of that in terms of the U.S.'s influence on Israel?
Well, look, when you say was not aware of, do you mean the killing of Ismail Haniyeh, or do you mean the Lebanon event?
It's more a question of whether they were part of or understood what happened with Lebanon over the weekend.
There is no question the United States would have been completely aware of Lebanese Hezbollah activities. The nature of U.S. And Israeli intelligence relationship is extremely tight. And also we have a vast array of military personnel and capacity in the region, which are capable of monitoring Hezbollah operations as well. It's likely that a geospatial and other intelligence collection methods were used to monitor Lebanese Hezbollah, and we probably were aware of what was happening.
Norm, look at the tension and where we're at. Let's take a giant step back. Tension continues between Israel and Lebanon. The war continues between Israel and Hamas. And the backdrop, we've heard from several officials who have given us the impression that we're pretty close to striking some kind of deal around ceasefire talks. What evidence is there, Norman, that we're getting closer?
Nothing public. There might be something in private again, but I think you're going to see that as Israel closes down its operations in Gaza or moves them to a lower level, the weight of Israel Defense Forces focus is going to move towards Lebanon, both to deter Lebanese Hezbollah and also to create security conditions that enable 60,000 Israelis to return to their homes.
Norman Roule of CSIS. Norm, thank you, sir. Appreciate it. Tension continues. Tragic loss of life continues. Talks continue too. We've been told repeatedly we're getting closer, that this was the moment to make something happen, to strike a deal around ceasefire talks. And to Norm's point, you never know what's happening behind closed doors. You never know how close we actually are. But in public, feels like we're as far away as we always have been.
This is a complicated moment. It's also complicated because you could tell that Iran and Lebanon do not want a wider altercation. And at the same time, there's a real pressure the longer that the altercation goes on in Gaza with domestic pressure. People who are seeing the news and are getting very angry about it. So it's a very tense situation, and it's hard to get a real handle on what's actually going on.
If you are just joining us this morning, welcome to the programme. Just to touch base on where the scores are right now. Equity futures on the S&P positive by a little more than 0.1%. With an update on stories elsewhere, with your Bloomberg brief, here's Johanna Hackers.
Hi, John. Germany's business outlook held at its lowest level since February. The IFO Institute's expectations gauge dipped to 86.8 in August from a revised 87 the previous month, with expectations worsening in both manufacturing and services. Optimism that Germany would rebound in 2024 from 2 years of almost zero growth has faded as an anticipated jump in consumer spending failed to materialize, and the country's industrial sector continues to struggle. Meanwhile, the firm behind the messaging app Telegram has questioned the grounds for France's detention of its CEO, who was taken into custody at a Paris airport over the weekend. Russian-born billionaire Pavel Durov was detained on suspicion of failing to take steps to prevent criminal use of the app. This, according to AFP. And Dutch authorities fined Uber around $324 million for transferring personal data of European taxi drivers to the U.S., and the largest penalty ever issued by its watchdog group against any company. The Dutch Data Protection Authority said Uber was collecting information of drivers from Europe, such as taxi licenses, location data, and in some cases criminal and medical data, and then retaining them on servers in the U.S. Uber indicated it plans to object to the fine. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next on the program, the time has come.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
That conversation up next, live from New York. You're watching Bloomberg TV. From New York City, looking to build on 2 weeks of gains on the S&P 500. Equity futures at the moment positive by 0.15%. In the bond market, yields lower by a basis point. The 10-year 378.95. Under surveillance this morning, the time has come.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions.
So here's the latest. The Federal Reserve preparing to cut interest rates, with Chair Powell now firmly focused on the labor market. Conrad Dequadros of Brean Capital writing the following. The August jobs report derailed the first rate hike in 2015, and we appear to have the possibility that it could push the Fed to a half-point cut in 2024. He has left the markets to be potentially hypersensitive to upcoming economic releases. Conrad joins us now. Conrad, get into that. Are you saying that September 6th is truly the difference between going 25 or 50?
Good morning, John. I think that it is going to be the big decider of the size of that rate cut. Now, I think that my baseline is that the Fed cuts by 25 basis points. But the reason why I brought up that prior incident was, we had all the discussion heading into the September 2015 meeting when the Fed was looking to hike rates for the first time about how they shouldn't be overly sensitive to a particular data release. Then we got a disappointing August jobs report in September 2015, and the Fed kicked the first rate hike to December of that year. And we're setting up for a similar kind of situation this time. If we were to get a very disappointing jobs report for August on September 6th, and the market were to move to significantly price in a 50 basis point rate cut, I don't think that the data justify that kind of a move. I think we need a strong signal that the economy is in recession or severe stress in the financial system. We don't see, or I don't believe there's evidence of either. But the markets could move towards a 50 basis point rate cut on that September 6th jobs report. And then that puts the Fed in a very difficult position. Do they want to disappoint markets? And I think probably not.
And if they cut by 50 basis points, how much more do markets price in later on in the year, with already more than 200 basis points of rate cuts priced in by the end of next year? A question that I have is just, how much is inflation actually off the table? Is inflation even in the picture anymore for the Federal Reserve, and should it be?
Well, Lisa, that's a very good point, because, of course, this week, the important data release is an inflation data release, and that comes out on Friday. And the broad consensus is that we get a 0.2 core PCE reading, which I think would be welcomed by the Fed. That's the kind of gain that the Fed is looking for. But on a 0.2 increase, we'll get a slight pickup in the year-over-year inflation rate to 2.7% from 2.6%. And Powell at the July 31st press conference has re-emphasized the year-over-year rates rather than the shorter-term rates. So 0.2 on a short term is a great number. It'd be consistent, I think, if we look at 3-month inflation rates with inflation close to 2. But 2.6 but 2.7 on the year-over-year rate is not the direction that the Fed is looking for. So can they really say inflation is? I mean, I think that they're not telling us that they're not looking at inflation anymore. They're just saying that they're looking at inflation and employment on more of an even setting. That both of those two mandates are important to them. But clearly on the inflation data, and I think that will be the message on Friday, is that we can't completely ignore the inflation data yet, and we're not yet at target, and the Fed still has some work to do there.
There's a question here, too, about how much they're really giving a destination in terms of what the neutral rate eventually will be. How important is that, given the fact that they're talking about don't focus on the pace, focus on the destination?
I think it's very important because if we look at what the Fed is telling us in its SEPs with the 2.8% Fed funds rate, I mean, that's kind of supposed to be, I think, the signal to markets of where the destination is. And I'm not convinced that the Fed believes that as strongly as they may have in terms of where the long run rate on the SEPs was pre-pandemic. So the markets are taking that, though, right? If we look at where rates are headed in interest rate futures, we have by the end of next year a Fed funds rate that's priced close to 3%. But is that really neutral in this current environment? And I don't think that that's the case. I think the neutral interest rate was probably never as low as the Fed was estimating pre-pandemic. And now they're not as convinced that they can cite that rate with a high degree of confidence. And so that's where I think the disconnect is. Look, if we have a recession, I would not be surprised if we see the Fed funds rate head as low as 3%. If we don't have a recession, though, and this is just an adjustment, and I think that's the signaling that the Fed is giving us, that they don't believe that there's a recession. They think that there just needs to be some adjustment to a Fed funds rate that doesn't need to be as restrictive with inflation now closer to target, but not yet there. So we need restrictive policy. It just doesn't need to be as restrictive. 3% Fed funds rate, I think, is accommodative. And I think that most Fed officials would say the same thing, even though that's in conflict with what the SEPs are telling us. That long-run date in the SEP is very problematic.
Conrad, if we reflect and just take a little bit of a step back again, if we reflect on what this get-together was meant to be about, it's meant to be about the transmission of monetary policy, the efficacy of policy. And he alluded to something pretty important in the speech. He basically suggested that high rates weren't a big factor in reducing inflation, that the story in the labour market was a supply-side one, which I think begs the question, Conrad, just how restrictive the chairman thinks we actually are.
Yeah, that's a great question, John. And I think, you know, depending on what we're looking at, you come to different answers. I mean, I think the Fed needs to take a bit more credit for the disinflation that we've had. I do think that that's a function. The inflation that we had was a consequence of too accommodative policy for too long and dismissiveness of the inflation dynamics. Now the Fed responded, starting in 2022, very aggressively to the rise in inflation. And I think that that's the reason why we have had this disinflation, and the Fed should take credit for that. Now, the other questions are, you know, the economy, outside of some signals, and I don't want to be completely dismissive of the somewhat disconcerting signals from the unemployment rate, but, you know, at the same time, we have jobless claims that are very low. So if there has been that degree of increase in unemployment, why aren't those people filing unemployment benefits? We have things like a very important indicator to us at Brean is profits. That's another important release that we get this week within the GDP report. We have profit margins that are still very healthy. And as a result of that, you see the response in the equity market with equity prices that are very high. So all of those things don't suggest that policy is overly restrictive and therefore needs to be adjusted very aggressively. But I do think you could make the case that some modest rate cuts are that would be a reasonable path for the Fed to be on, given the disinflation that we've had. And I think that's the path that the Fed should take. But what happened on Friday with the speech was, and I don't think it was a bad speech, but I think that Powell probably could have done a little bit more to drive home that what the Fed is thinking now is more in terms of modest adjustments in the Fed funds, or maybe take a little bit of the emphasis off the September meeting.
Got it.
Sorry, the September 6th employment report.
Yeah. Conrad, thank you, sir. Conrad Dequadros there of Brean Capital. Looking ahead, Neil Dutch of Renmac. He did the word search on the speech. No mention of gradual at all. The word didn't come up in the speech at all on Friday. Gradual reductions. Looking ahead to Thursday, jobless claims 232. 232 is the estimate, Lisa. The previous week, 232.
And we got it bang on. And you asked this question, and it was a really good one earlier, which is how much are people biased to a downside surprise? But if it's, you know, if we've got fewer jobless claims filed than expected, will that measure? Or will people just say, just wait a while and then it'll weaken more materially?
Based on the bias on Wall Street at the moment, the people we speak to, they seem to be more willing to embrace the weaker data and ignore the strength. But we'll see. At least the economists waiting for those revisions on non-farm payrolls. This is an ongoing conversation. In the next hour on Bloomberg Surveillance, Linda Duessel of Federated Hermes, Henrietta Treyz of Veda Partners, Bloomberg's Guy Johnson on the latest with SpaceX, and former Fed Governor Betsy from New York. The second hour of Bloomberg Surveillance up next.
We've got this momentum-driven bull market.
The market's essentially pricing in, I would say, 20% chance of a recession.
The market is rightfully focused on the importance of growth holding up.
The market's kind of transitioned now to we're in a slowing growth environment. So now we have to trade slowing growth and decide whether it hard lands or soft lands.
It's very plausible that we don't have a significant correction and we grind higher from these levels rather than going lower.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now as Chairman Powell supports new leadership in this equity market. Check out that leadership. Last week, the small caps up by more than 3.5%. The regional banks up by more than 5%. This morning, your outperformance on the Russell. The small caps up by 0.9%. On the S&P, up by 0.1%. On the Nasdaq 100, up by 0.07%. Your week ahead is absolutely stacked. It's always stacked, but this time it's absolutely stacked. 2 points I'd pick out for you. One is Wednesday, the other is Thursday. Lisa, NVIDIA earnings on Wednesday. Then the big one for you, it's jobless claims on Thursday morning.
NVIDIA is obviously going to be very important. I don't want to diminish that. I think from an economic standpoint, though, jobless claims really goes into this question of how data point dependent is this market, given the fact that Fed Chair Jay Powell squarely opened the door to a potential 50 basis point rate cut as long as you did see a downward surprise. Key question, and we've been analyzing it all morning and we will continue to do so, how big of a downside surprise does he need to see? How high is that bar before he makes a bigger move?
We're going to ask people what number, aren't we? Is it 100K?
It's going to be so exciting.
125K?
Exactly.
Median estimates so far in our survey is about 160. We'll find out. 100, 114 last
87.
time around with that too. 87 precisely on the nose.
87K, that's it, 50.
The fact we're even joking about this, Conrad Dequadros of Brean Capital said it just moments ago. Because of that speech on Friday, whether this was the intention or not, it is the outcome. Market participants are hypersensitive now to one data point, the August payrolls report on September 6th.
What you pointed out was really important, and Neil Dutta did note this, that he didn't talk about gradual or in some sort of methodological kind of way in terms of rate cuts. So how much is this a Jay Powell question and how much is this a committee question? There still are some committee members who are pretending to be somewhat vaguely hawkish on the edges. But in general, people are wondering how quickly they're going to go. And then how much does the market move on that to one direction at a time where in the past rate cuts heralded some sort of weakness, right? At what point are we really looking for any weakness or just basically taking the soft landing as a given?
Purely an observation based on some of the conversations we'd heard going into that speech from other Fed officials. This was almost Draghi-esque, this speech was. And the reason I say it, for people who weren't familiar with the former ECB president, the former ECB president had a habit of basically taking the whole governing council with him, whether they liked it or not, and basically said, this is my view, and guess what, it's yours too. And then they'd complain about it to various news outlets, including this one, but ultimately he'd end up getting what he wanted. Chairman Powell, traditionally, the Federal Reserve is sort of a consensus builder, reflecting the consensus of the committee. That sounded like the chairman was speaking for himself. That's not my opinion. That's just a judgment based on what we'd heard from other Fed officials. There is a clear difference, just objectively, a clear difference between what we heard from other Fed officials on Friday versus what we heard from the Fed chair.
Just to build on that, will we start to see dissent? Right? I mean, is this a time where he's foregoing consensus for getting his view out there in the forefront, or is he going to try to wrangle some sort of consensus? We've seen the longest consensus going back many years. A real question here about how much he really wants that versus an outcome that he truly believes in his core that he could potentially get ahead of a real deterioration in the labor market. I don't know the answer, but I do know that right now it seems like there is a bit of a division in terms of the pace, but not the direction. Everyone was talking about the potential for rate cuts. The question now is just how quickly and whether the data will disrupt. I don't know in terms of his personal opinion. He clearly, though, is more dovish than other members.
Would you like something contrarian from Ian Shepperton and Pantheon Macroeconomics? Something just a little contrarian. We think the data over the next few months will make market pricing look too conservative. I'll read it again. We think the data over the next few months will make market pricing look too conservative. We expect 125 basis points this year with a further 150 next year.
Too conservative in which direction? If you end up with data that encourages the Fed to go that deeply, is that positive for risk assets? I really struggle to understand this at a time when, in the past, Fed rate cuts usually were before the troughs in markets, that typically people recognize the weakness after the Federal Reserve started to cut rates. So if you start to get that data, are we talking about too conservative in terms of just how far the Fed will cut rates, or also too conservative in the potential weakness that you could see in risk assets on the back of that?
And that's the most important question if you're in this equity market right now. Equity futures up by 0.2% on the S&P. S&P. In the bond market, yields lower, particularly the front end last week, by double-digit basis points on a 2-year. The bulk of that, coming Friday after that speech from Chairman Powell. The 10-year down to sub 380, 379.33. In the FX market, the euro 111.71. German business confidence absolutely terrible. Just bad. And I'm not even overdoing it, Lisa. Just not a great read from the EFO index at all.
Yeah, it actually went to the lowest level since February, holding at that level at a time where people are wondering, well, maybe they're coming out of what has been essentially a recession in the biggest economy. Question here is, how does the European region face off with these dual risks that are very different? They've got inflation that's measured as higher than in the U.S. by some metrics, at the same time that you have growth that's weaker. And you felt that kind of tussle between those two European officials who were at Jackson Hole. They seem to be talking, though, more about addressing the weakness also, which means it'll sort of be a race to the bottom.
I imagine they didn't use this language. The EFO president, the German economy is increasingly falling into crisis. It's pretty punchy language, isn't it?
Yeah, that it has been stuck in stagnation for some time, and this is getting worse. That is what the data is telling us. What's the response to that, though, for Germany? It's not rate cuts. Is it fiscal spending? How does that deal with, the fact that they typically don't like to widen the deficit, especially at a time where borrowing costs aren't free? It becomes a real conundrum.
The German model just broken. 111.71 on euro dollar. Coming up this hour, Linda Duessel of Federated Hermes following Powell's pivot. Henrietta Treyz of Veda Partners as Harris and Trump step up campaigning. And former Fed Governor Betsy on the case for a 25 basis point cut in September. We begin with our top story. Fed Chair Jay Powell's speech in Jackson Hole sending stocks back towards all-time highs. Linda Duessel of Federated Hermes writing the following. The market is pleased to hear that Powell is keeping a close eye on the labour market and will perhaps continue to cut in order to stave off a recession. It's a soft landing if we have succeeded enough in reducing inflation while not harming the labour force. That is bullish. Linda joins us now for more. Linda, I want to understand if the leadership is bullish. So you've identified the same thing, and I think it's important just to spend a little bit of time on this. I think the bulls would identify the rally on small caps and regional banks and say, this looks good, improving breadth. Mike Wilson of Morgan Stanley was on this show last week, and he said, look at the performance in utilities, staples and healthcare. There's a defensive character to all of this. How are you framing things for your clients?
Well, good morning. Thanks so much for having me back. It's basically a broadening of the market. And it's funny, you wouldn't normally think that small caps and financials, which are an early cycle play, would be running at the same time that defensives are running. And here we are in and around the highs that we were at in July before the pullback. But the 10-year bond yield, I think, is 30 basis points lower than it was then. And then these, the REITs, the utilities, which are very much interest rate sensitive and also defensive, are really starting to catch a bid. What do these stocks all have in common that are catching a bid is that they've been ignored for a very, very long time. And if we believe, which we do at Federated Hermes, that we're not going into recession, but a slowing down of growth, then you can go out there and buy those stocks because they're inexpensive. They're priced to where the downside probably isn't much.
Linda, we get a lot of guests coming on here and saying that good news is good news and bad news is just bad news. Can you help us understand? Lisa and I went back and forth on this just a moment ago. Help us understand what actually is bad news. Everybody comes on this program talking about September 6th, the August jobs report. What is a bad number? What would you believe would be a bad number to this stock market?
That's funny. I was really hoping you wouldn't ask me that question. What's a bad number? What's a bad number is that it keeps on going down. We really wouldn't want it to surprise, but it's the trend that is most important because, as we all know, these job numbers get revised, and then the difference between the national payroll number and the household number, and they're different. You have had this problem with all the jobs that all the immigration, all the people that have come in to swell the labor force. I would just say that what is really positive as the labor force goes is that the job participation rate in the prime age group, that would be the 35 to 60-year-old age group, is going up. That's really good news. And so, yes, you don't have 2 job openings, for every unemployed person. That was a super tight job market, and you're coming back to normal. We believe that there's a balance that's going on, and that's a good thing. So we just don't want to see those weekly those weekly job numbers continue to move up. And they're kind of stagnant in a range. That's good. That takes us back to, all right, it's a slowing market, it's a slowing economy, but we're not going into recession. And that's bullish.
So, Linda, basically, you're not even going to address the idea of weakness because you're not seeing it. Is that basically what you're saying?
Oh, no, we're seeing weakness. No, I don't want to say that. I'm saying we're seeing a weakening of an extremely strong bull market. We've seen a boom market that came from massive stimulus, more stimulus than we've ever seen in the history of our country. And that's coming off, and that's natural and normal. And we're seeing inflation that was really, really high come down a pace, not 2%, but 2.5%. That's good. A pace is good. Slowing, no recession. That's what we want to say.
Let's talk about the other data point of this week that potentially could be somewhat market moving, and that is NVIDIA earnings. You talk about how there is this redistribution in leadership and this sort of push towards small caps and the equal weight, which is at a record high. How much could you get a sort of decisive earnings report from NVIDIA that could shake that balance, or have you changed either back to an overweight in some of the big tech cap numbers, or do you look at just this sort of broadening out as holding regardless?
So the broadening out is a very good thing. NVIDIA is a market moving event when they tell us what their earnings number is. The top 10 names have never been such a large percentage of the entire market cap of this S&P, nor have they been so large a percentage of the earnings of this S&P. I would say that, if indeed they were to miss whisper numbers, for example, the stock could go down. That could potentially be a buying opportunity, and I'm not an analyst for that stock. But it is a very, very strong space, this entire AI space. It's not going to stop or slow down anytime soon. And these stocks, if they are rather expensive, are nowhere near as expensive as the stocks were at the time that the bubble burst back in 2000. So again, if you should see some disappointment there, and it would pull down the S&P, it would be because of the largest names. And this would not negate a slowing but still growing economy and a broadening of the stocks.
Linda, is that the best way of valuing some of these stocks, to benchmark to one of the most extreme periods of valuation in the history of this equity market? What is the best way of benchmarking some of the valuations of these names right now?
Well, I'm just using that example to compare because it's such an important name. It's unusual that one name or 10 names or 7 names or whatever are such a big piece of the market. But these companies are, large cap growth companies, technology companies. That's an exciting time, is when there's a vast movement in tech, a revolution in tech, if you will.
Yeah.
And then we all gravitate toward those names and the promise of those names. The trouble that we always get into in one of these situations is we extrapolate extremely high growth rates for too long. And you can only grow so high, so long, and then you slow down your growth rate, and then you slow down your multiple. Slowing down is okay. If I remember, I'm not comparing exactly to that time. I'm just saying that I was alive back then. I was in the market back then, and the market crashed for names in that tech space, not because of anything they were doing wrong or even their valuation. It was a slowing of an economy that was probably heading into a recession, which we don't see.
We appreciate your experience as well, Linda, and your take today. Thank you. Linda Duessel there of Federated, Hermes, on NVIDIA just at the end. We will speak to an analyst a little bit later, Pierre Ferragu of New Street Research, joining us in about an hour from now. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Tensions escalating in the Middle East as Israel and Hezbollah exchanged fire over the weekend. More than 100 Israeli warplanes hit missile launchers in southern Lebanon Sunday morning. Hezbollah responded with a rocket and drone attack that killed one Israeli soldier with fallen debris. Israeli officials claim the strike prevented a massive assault planned by the Iran-backed militant group, and Israel has declared a 48-hour state of emergency. Meanwhile, Italian authorities say the victims aboard Mike Lynch's yacht were likely asleep or tried to escape as it sunk off the coast of Sicily last week. Prosecutors are beginning a probe for charges of manslaughter and negligent shipwreck. The chief Sicilian prosecutor saying there are currently no suspects. The probe is being conducted against, quote, persons unknown. Survivors of the wreck, including the captain and crew, weren't immediately tested for drugs or alcohol as authorities focused on first aid. And Apple is planning to unveil its latest product lineup on September 10th, including new iPhones, watches, and AirPods. Sources telling Bloomberg that Apple is only making preparations for that day, with concrete plans still under wraps. It's a critical launch for Apple, which has seen sluggish iPhone and wearable sales in recent quarters, and the pressure to keep up with AI advancements is only increasing. If the launch happens September 10th, the latest phones will go on sale September 20th. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for that. Up next on the program, the sprint to November.
Harris, I think, is about 60% likely to become president. I think the momentum, the aspirationalness of the thing, I think that really kind of carries her.
A conversation up next, live from New York City this morning. Good morning. Stocks are positive. It's waking up this Monday morning. Good morning to you all, up by 0.2%, just about rounding that up for you. In the bond market, yields just about unchanged. Your 10-year 380.46. Under surveillance this morning, the sprint to November.
Harris, I think, is about 60% likely to become president. I think the momentum, the aspirationalness of the thing, and frankly, the appeal of the new as opposed to the kind of dreary last decade that we've had. I think that's how voters are increasingly looking at it. I think that really kind of carries her, and you see Trump on the defensive, not really able to land a lot of punches.
So here's the latest. Vice President Kamala Harris back on the campaign trail this week as her campaign rakes in over $500 million post-DNC. And Donald Trump is maintaining a heavy presence in swing states after a week of counter-programming the convention. Henrietta Treyz of Veda Partners saying the following. Post-Labor Day, she could be in the lead nationally and in critical swing states by enough of a margin to emerge as the favourite to win the election. Harris has ushered in dramatic shifts in the electoral landscape, but is not yet favoured to win the election, in our opinion. Henrietta joins us now for more. Henrietta, thanks for being with us. I want to start with those numbers. Harris' campaign and affiliates have raised $540 billion since Biden quit. How does that stack up against campaign Trump, and how are they spending it?
Well, it doesn't compare to the Trump campaign at all. The Trump campaign is down into something in the range of about $63 million for the entire month of July versus over $240 million for the Harris campaign. The two are not equal. If you're looking at the fundraising numbers, the DNC versus the RNC, voter galvanization, the number of volunteers they've gotten in swing states, it's almost double the size, if not more, in the Harris camp. And I think that's something that the Trump campaign is actively worried about right now. You saw it from their internal polling memos this weekend. They're anticipating that not just has Kamala risen 6 points since she started the race just a few weeks ago, but she's going to increase another 2 to 3 points in the next couple of weeks, the next couple of days after the DNC. That's a natural bounce, but one that would supersede Trump, and it probably won't fade. When you think about what Trump is doing on the trail, he's not going to campaign until Thursday. And Friday, he'll be in Pennsylvania. I mean, every single day is critical here, particularly when you're behind like the Trump campaign is now.
Just to go a little bit deeper into these numbers, the 540 million, if I said billion, excuse me, 540 million. One third, yes, a heck of a lot more money. 1/3 contributed in convention. First-time donors, since the convention, were first-time donors. 2/3 were women. It's the gender split here, Henrietta, that's interesting. That gender split, how firmly entrenched do you think that actually is? The split between women and men in this country and who they're supporting?
It is extremely firm. And I don't say that because it's just in the national data. It's in every single swing state as well, often by 10, 11, 12 points. It's particularly noticeable amongst young male voters and every other female demographic. And it's even more pronounced between young male voters and every other age demographic of older male voters. So there is this extreme gender divide that is expanding and becoming more obvious as the race wears on. What the Harris campaign is going to do to dig into those numbers a little bit further with their super PACs like Future Forward is they're going to spend $370 million on ad campaigns between now and November 5th. So get ready to hear a lot about Kamala Harris and her campaign.
How much is this gender divide really hinged to the issue of abortion? And how much can Trump really counter that by coming out with things like what he did over the weekend, talking about how he believes that states should decide for themselves, that there shouldn't be a federal abortion law, but that each state can make their own decisions?
You know, I think that the state decision piece is really problematic because you have these state decisions being made at the ballot in November. In Florida, for example, where I think 2/3 of abortions in the South are conducted, there is a ban now at 6 weeks, and they need to vote on that to maintain it in November. Whether it's Louisiana, Arizona, Nevada, I mean, these issues are on every single ballot. So the last thing you want is a repeat of 2022, which was a real problem for the Republican Party at the Senate and in the House. And that's what they're headed towards in 2024. And the messaging from the Trump campaign with J.D. Vance and Donald Trump trying to come out as, pro-IVF, but really saying some fundamentally problematic things about family planning, to put it nicely, is something that is alienating, I think, a lot of voters. And it's not just women. It's voters across the spectrum. Abortion is the number 3 issue that voters care about after inflation and immigration right now. And immigration and abortion are pretty neck and neck.
In the meantime, your first point, inflation, is something that we've not heard that much about. We heard, of course, the price gouging type of discussion from Kamala Harris, although we've seen some of her people walk it back and talk about how she's not actually going to get it passed and that it actually isn't, an effort to take money away from grocery stores and things of that nature. I'm just wondering, how much are you getting a sense that the criticism of Kamala Harris, that she isn't coming out with real policy, how much is that landing?
I think that it's landing amongst sort of the media groups, but amongst the general electorate, you don't see any of that translating to either her polls, her fundraising. I mean, they made $86 million just last week alone. So the issue is not that she is not getting out in front of journalists and the press. That's an issue for the Trump campaign. But the American voter that's now newly galvanized, Democrats are 83% enthusiastic about this election versus 71% of Republicans. It's not resonating with the average voter. And I think the real problem for Trump is that she doesn't need to get specific on policy. We don't really need to have a robust discussion about where do you think carried interest tax rates should be or capital gains tax rates? What kind of revenue are you trying to bring in to offset the cost of the child tax credit? We don't need any of that. We just need this sort of forward campaign versus do you want to go back to the Trump administration of the 4 years that he was in office? And that's really what the campaign is about. And I don't see that changing over the next 71 days.
Can we talk about policy? Forgive me, but we want to talk about policy, so hopefully we can do that. This news came out from Canada, from our team just moments ago, according to people familiar with the matter. Canada would impose new tariffs on Chinese-made electric vehicles, aluminum and steel, lining up behind what we've heard from the United States already previously. The government plans to announce a 100% levy on electric vehicles, 25% on steel and aluminum. Canada agrees with the United States. This seems to be where the world is when it comes to tariffs and China. How much daylight is there between Trump and Harris on this very key issue for a lot of voters?
Well, I mean, let's be mindful that the Biden administration just a couple weeks ago, or months ago, put in the 100% electric vehicles tariff, the 3 times higher steel and aluminum tariffs, or steel tariffs. There is no question that the Trump administration started with tariffs, and the tariffs under Biden are higher and more exhaustive now than they were under Donald Trump. The USTR, the Department of Commerce, all the investment restrictions, export control restrictions are only growing. I don't see any scenario where any of these tariffs come off once they get put on. Think about what you'd have to see in order to take the tariffs off. You'd have to see China capitulate, China prove and then sustain that they have made changes on forced tech transfer, climate change, human rights, state subsidization. None of that is occurring.
Henrietta, thank you. Henrietta Treyz there, Veda partners, squeezing in some policy at the end. The Harris campaign are calling tariffs a Trump tax. Yet you heard Henrietta just then. Those taxes have gone up under this administration in many places.
We're not going to get a discussion, though, deciphering good tariffs from bad tariffs and what exactly the tariff policy is going to be. But it's one that we could be having because it's a valid one, especially in light of the fact it's what's happening.
Up next on the program, another setback for Boeing in space. stocks on the S&P coming off the back of 2 weeks of gains on the S&P 500, adding just a little bit of weight to the recent rally, up 0.1%, but some clear outperformance again on the small caps. We saw this on Friday, just a really strong day of gains, week of gains, up by more than 3.5%. It continues this Monday morning, Lisa. The Russell up by 0.8.
Just to sort of put that into perspective, on Friday we saw a new record high for the equal weight S&P 500, even though just the market cap weighted S&P still is away from its all-time high. How much of this is sustainable, though, if we get a true weakening in the data? And this is something that Linda Duessel didn't even go to, because she said, frankly, we're seeing a weakening from a very strong pace, but we're not going to get that. We're not seeing any indication of that, which is the reason why people are so willing to embrace a soft landing or rate cuts will really help some of the more leveraged companies.
After what the Fed chair said on Friday, is bad news still bad news? Given how sensitive he is to it?
It's a great question.
Left out the word gradual?
A lot of people think that that's not the case. I mean, at a certain point, you have to wonder if there is a lag effect to how quickly some of the rate cuts could affect the overall economy and boost it. Ostensibly, based on history, bad news will still be bad news at some point.
Think how this market and market participants responded to August 2nd and the payrolls report for the month of July. So that's absent the speech we heard on Friday. And there were guests out there talking about emergency rate cuts and talking up the potential of going 50 and not 25. Could that change even more if we get a really weak print on September 6th? Like, what's the next leg? You know how markets work. They're always pushing for the next chapter. What's the next page of that story?
Do we go back to zero?
Right, 75.
Negative rates?
Right.
Yeah, exactly. Look, it's a legitimate question. At a certain point, this really goes back to, have we really eradicated inflation as one of the potential risks out there? If that is the case, then, the floor is the limit and you could keep cutting. If we still do have some inflationary pressure, that calculus becomes a whole lot more complicated.
Even after Friday, in fact, I think because of Friday, there is a view that this chairman is still highly, highly data point dependent. And you have to remember that when we started to go, 50 to 75 in the rate hiking cycle, it was off the back of UMich consumer sentiment and the inflation expectations embodied in that, which led to a leak in a certain newspaper and a much larger hike than we anticipated.
All right, if you take a step back, it's clear that their bias is to cut, and they're looking for an excuse to cut rates significantly. And that, I think, is what you're saying about the data point, right? Is there a data point that gives them a reason, an excuse to cut more significantly? I do go back to what Loretta Mester as well as Patrick Harker had to say, that they expect a 25 basis point rate cut followed by a 50 or even more of a rate cut later on. They pointed to the initial rate hike, and they said it was initially smaller, and then came the 50 and the 75 and the bigger ones. They don't want the market getting ahead of itself, but that's not to say that they're not on board with some pretty significant rate cuts, even just to match the restrictiveness necessary for inflation that has come down.
I'm just stirring up the pot, just seeing how things go over the next few weeks. Not necessarily my view, that's for sure. Let's switch on the board and get to the bond market. A 2-year, 391.25, a move of more than 10 basis points lower last week. The bulk of that in Friday's session. We're down to about 380 on a 10-year maturity, on a 30-year, up about a single basis point, 4.1%. Lisa, you mentioned this in the programme on Friday in our special programming. You mentioned it again this morning. Not exactly walking away from the Powell speech with a decent impression of the destination. We're still obsessed over the speed of the journey, and the journey that we're going to begin potentially on September 18th.
This was supposed to be the time where they talked about a neutral rate, where they give you a sense of the destination, and they avoided it with everything that they could, all of the Fed officials who we spoke to. To me, I'm looking out and I'm seeing maybe like a 3% or a 2.5% destination. They don't really agree on any particular point. But this raises the question, are they okay with a higher inflation rate? Are they looking at a more inflationary economy? They don't know. All they know is that there is weakness coming down the pike and that they're going to get ahead of it. And that's the reason why people are getting enthusiastic without necessarily understanding some of these bigger questions that plagued the market for quite a while.
The closest the Fed chair's come to saying mission accomplished without saying mission accomplished. Did it feel like that Friday? You were there.
A bit. Started talking about history, his place in history, the path that they had. It was a very sort of grandiose speech in that way. I will just say we do have $69 billion of 2-year notes being auctioned tomorrow and $44 billion of 7-year notes auctioned on Thursday. I am curious to see if these are really truly non-events, if you have plenty of bids, or if you start to have some pressure over the long end. What does this mean for longer-term inflation rates? And that, I think, is going to come more into the fore, particularly with the political schedule.
Just squeezing in a little bit of bond supply. Welcome back, Bramo. Let's turn to the third board. I want to talk about foreign exchange. Two currency pairs, two stories. In the FX market, euro-dollar 111.64. That euro weaker by 0.25%. German business confidence weak, week. The IFO president saying the German economy is increasingly falling into crisis. 111.64. And I would say a structural crisis. That's the issue here, Lisa.
A Bloomberg terminal user messaged us, and I think this is actually fantastic framing. The German economy simplistically is a car company. They are in a bad place with the electric vehicle evolution. Hence, growth will be anemic for some time. How much is their economy completely leveraged to the auto sector that is facing the headwinds of both the electric vehicle transition and the complications there, as well as pressure with China and the introduction of a lot of EV vehicles coming from that country at a time where there's increasing fissure between the West and the East?
Bad policy, potentially. We can have that conversation another time with some real depth, but economic issues of their own doing. I mentioned two currency pairs. That's the euro. Just want to finish on dollar yen. Just purely an observation here. The good news for many of you, dollar yen's been moving like this now for a period of time. Yen strength. And the correlation between yen strength and risk appetite is totally broken down. And I think for many people, US-based investors who don't want to spend their mornings and their nights waking up and checking a currency pair and seeing how dollar yen is doing, this is probably welcome news.
That's what we heard from Peter Tchir. Basically, we've seen a complete annihilation of fears around the boogeyman of the yen carry trade. That said, let's see. Let's see if things get disruptive in a more significant way. But yes, maybe we overstated just how disruptive that was at a time when people were looking for excuses to trade, and there were also leveraged funds that were having some hiccups.
Dollar yen, 144 in the FX market. Under surveillance this morning, let's check out crude. Oil rising as Middle East tensions ramp up. Israel taking out thousands of Hezbollah missile launchers yesterday in what it called a preemptive strike. Israeli officials saying Hezbollah responded by firing more than 200 projectiles that caused limited damage. That move you're seeing in crude, though, the tension's only one part of the story. Brent crude's up by 2.8%. The move today, Lisa, earlier on, around the latest out of Libya.
Yeah, Libya actually preventing exports as well as production in the eastern region as they face some sort of takeover attempt of the central bank governor, in particular, the central bank governor exerting this halt on exports as well as production. It highlights how much uncertainty there is. I will also note one other story that came out overnight that also kind of colored the pricing of oil, and that is that Russia attacked Ukraine's energy supplies in a very significant way. So when we start looking at the response in the oil markets and attributing it to the Middle East, just a word of caution. There are a whole host of other issues that are coming to the fore that are also creating some pressures there.
Oil up by almost 3%. I want to turn to the latest on the politics. If you missed this earlier, we mentioned some numbers around the Harris campaign and the fundraising. More than $500 million. Massive numbers. The total fundraising haul reaching $540 million since President Biden announced he'd step aside, with $82 million rolling in during the DNC just last week. Some of the recent inflows, the breakdown, we mentioned this too with Henrietta Treyz just moments ago. 1/3 of those contributions were first-time donors. 2/3 were women. And the donations that we're seeing, largely a reflection of where the support is and where it's coming from in this country.
Although interesting, when you actually listen to her speech, she wasn't talking about breaking the glass ceiling and focusing on the fact that she would be the first female president. So it's sort of an interesting dynamic, a question of what's behind that. Is this the abortion policy? Is it something else? But you have seen this divide between men and women growing in the United States in a very dramatic way. And there have been a whole host of studies on that. I do wonder how long we can have a vibe kind of campaign rather than any kind of real policy. And according to Henrietta Treyz, that is what we're going to be dealing with for the rest of the time.
Don't you think the media needs to do a better job here to really start putting some pressure on getting some sit-down conversations, some interviews?
I feel like people have been trying to, but we just heard Henrietta Treyz saying it's a problem for the media, but it's not a problem for the voters. People don't seem to care. This is something that Republicans are leaning into. They're trying to accuse Kamala Harris's campaign of not coming out with any specifics. Whether it lands remains to be seen. I don't know that we've really gotten specifics from anyone that can actually be passed. Question then is, how much of a black box is anyone who comes into office if we don't really take seriously any of the proposals they put out there? It becomes a real issue.
You say they've been trying. I'll pick out an example, and I won't name the organisation by name. We're classy here. There was a magazine that came out recently with a massive cover story, a very favourable cover story, and they weren't granted an interview with the Vice President. Should you be going forward with that cover story and a very favourable story about the Vice President without a sit-down conversation? I don't think so. I don't think so.
We can discuss some of the coverage, et cetera. At this point, we are getting very close to voting. And I think that that's the point that Terry Haines could say, which is essentially next week, you'll start to get early voting in this country. So at a certain point, this is what you are getting. what you see is what you get in terms of a campaign that's already set to go into actual votes.
That's the latest on the politics. Let's turn to Boeing. Boeing facing a new setback to its space ambitions. NASA announcing over the weekend that it will not use Boeing's faulty Starliner craft to send home astronauts stuck at the International Space Station. The agency deciding it's safer to use Elon Musk's SpaceX. Boeing's down by almost 1%. Guy Johnson joins us for more out of London. Guy, how much of a setback is this? How embarrassing is this for Boeing?
It's hugely embarrassing. Of course, it's hugely embarrassing. They sent 2 astronauts up. They were meant to be up there for a week. They've been up there a couple of months, and now they're going to be up there until the beginning of next year. You've got to reconfigure a whole load of capsules, both on the SpaceX side and also on the Boeing side. They're going to bring the capsule that went up back uncrewed because they can't run the risk of bringing the 2 astronauts back in it. It's got thruster issues, and they're concerned about what the re-entry would ultimately look like. This is a program, John, that is already billions over budget, and it's behind schedule. It's been like this for quite some time. Boeing is saying that it is committed to the program. But remember, you've got a new CEO coming in. He's got a blank piece of paper, and he's looking at everything right now. So, yeah, it's hugely embarrassing. It's also potentially financially very consequential. There is a lot already invested in this program. What happens to it next will matter to Boeing shareholders.
You alluded to it, Guy. Build on that just a little bit. How blank is that piece of paper? Does the incoming CEO really have the option of stepping away from that business?
I think everything is on the table. Look, you have to figure out how you're going to right the ship. Let's say it is still a priority. Kind of how high is it in terms of the list of things that need to get done? How big a priority is it? Does he need to make sure that the civil side of the business is fixed first? Can he do it all? Is there enough bandwidth to actually solve all the problems simultaneously? There are lots of things going on at Boeing at the moment. The civil business definitely needs to be put back on an even keel. The MAX program, what happens with the MAX replacements is the next big challenge there. What is happening with the 87? What's happening with the 777X? There are lots and lots of challenges that need to be resolved for this company. You come back to the space program. Yeah, sure, it's going to be an issue and it's going to be something that this company has to resolve. But when does that ultimately happen? And do you have the luxury of time when SpaceX is doing what it's doing right now? Remember that it's got another launch going up. It's about to have another launch going up. It's going to be sending astronauts up. They're going to spend time in one of the highest orbits that we've ever seen. It is making progress. The problem here is you've got a competitor that is doing it better and faster. Do you stick with the program and continue to make losses? It's a really big challenge. Boeing has limited resources. It's got to figure out where it wants to spend them.
I would turn it on its head, Guy. Why should they continue with a program that has left them with losses where they're falling behind?
Because of so much that has been invested already, Lisa, and because this is going to be an area of growth going forward. Can Boeing afford not to be in space? I think is a key question that this company needs to answer. And I think that is going to be the challenge. It's really difficult to answer it at the moment. At some point, this business is going to be profitable. How much you need to put into it, how many resources, human resources, financial resources need to go into it to get to that point remains a really difficult question. This is unbelievably complex stuff that you're dealing with here. We all know that. And as a result of which, it's just a resource issue. But can you afford not to be in this? Ultimately, if further down the road, this turns out to be a hugely profitable part of your business. It's a really difficult question. And there's so many unknowns here. Kelly Orberg's got some really difficult challenges and questions that he's got to answer. We don't know yet. At the moment, he says he's committed, but this company is falling behind SpaceX in a very big way at the moment.
Huge win for Elon Musk. Guy, thank you, sir. Guy Johnson there with the latest out of London. Equity futures just rolling over just a touch, still positive by almost 0.1% with an update on stories elsewhere this morning. With your Bloomberg brief, here's your Hara Hackers.
Hi, John. Ukrainian President Vladimir Zelensky says Kyiv's incursion into Russia is part of an effort to make Moscow accept, quote, fair peace. Ukrainian forces are claiming they control over 1,200 square kilometers of territory amid Ukraine's first foreign military offensive inside Russia since World War II. Russia's defense ministry says its troops continue to repel Kyiv's efforts in several regions in the Kursk region. Meanwhile, Canada is imposing new tariffs on China targeting electric vehicles, aluminum, and steel. That's according to people familiar with the matter. Canada will impose a 100% levy on EVs and 25% on steel and aluminum. Prime Minister Justin Trudeau is expected to unveil the policy in Nova Scotia, where he's gathered with his cabinet for a series of meetings about the economy and foreign relations. And Lando Norris won the Dutch Grand Prix, closing the gap on Max Verstappen in the Formula One driver standings. Verstappen finished runner-up and still holds a 70-point advantage in the championship with 9 races remaining. But Norris has closed the gap in recent days and told reporters after the race that McLaren now has the best car in the sport. The next race is at Monza this weekend. That's your Bloomberg Brief. John?
The best weekend. Yahara, thank you. Up next, Powell's dovish pivot.
Basically, with this speech and certainly with the July meeting as well, they've been heavily signaling that they're going to make this move in September and subsequent moves. So that's already been priced in the market.
That's up next. This is Bloomberg. The important stuff, this close to Oasis getting back together. Liam and Noel settling their differences and touring next summer.
Okay, you're going to go, aren't you? You're going to follow them around.
The one thing that I would go to. I wouldn't follow them around. I'm not that dedicated.
You're not an Oasis groupie?
I'd go to one event next summer if it happens.
Yeah, well, they were very underrated. A lot of people thought that they were, kind of lost in their time in terms of how good they were.
Is that like an American perspective on the band?
Well, music theorists believe that they were actually highly sophisticated and broke ground in ways that they were not appreciated for.
This is like a big deal for millennials. Like mid-90s.
Let's move on.
Big deal. Liam Gallagher's like teasing people out on Twitter, just saying 27th of August there's going to be some kind of an announcement at 8 a.m. So we'll see what we wake up to if this happens. These two brothers can't stand each other, can they? Have they settled their differences now? They're best friends again?
I don't know.
We'll see how long it lasts.
We'll get a historic scholar on. We'll do wall to wall.
We'll see how long it lasts. Equity futures right now in the S&P positive by 0.03%. That was our early bid for tickets. In the bond market, yields up by about a basis point. The 10-year 381. Under surveillance this morning. Powell's dovish pivot.
Basically, with this speech and certainly with the July meeting as well, they've been heavily signaling that they're going to make this move in September and subsequent moves. So that's already been priced in the market. I just think right now they just probably don't need to go 50 basis points. I think that would, trigger expectations about a really rapid pace of rate decline.
So here's the latest. Traders are awaiting the first round of data since Fed Chair Jay Powell confirmed rate cuts are coming, with jobless claims on Thursday and PCE on Friday. The debate turning to the size of the first rate cut and the future path of easing. The former Fed Governor, Betsy, writing the following. It would take something extraordinary to derail a 25 basis point cut in September. The question we've all got, what it would take to make it 50. Betsy joins us now for more. Betsy, wonderful to see you once again. Let's start with Friday and that speech on Friday. Lisa and I have got a similar question, and I think you might have the answer. Was the chairman speaking for the committee on Friday or speaking for himself?
So for the entire speech, he was speaking for the committee, except for the one line when he said, "My confidence has grown that inflation is on a sustainable path." And there he said "my," and that's very unusual for this chairman. And I think what he was doing there was he was expressing his own opinion, but giving the committee room, not front running the committee, but giving the committee room in September through the SEP to all put out their own estimates of both where the various indicators are going to be and their confidence in their forecasts.
Betsy, how big do you think the range will be in the summary of economic projections come September 18th? How wide is that range going to be?
The range of the projections themselves or the confidence. So the projections themselves, I don't think are going to be a terribly wide range or not more than usual wide range. But what I'm really watching for is the confidence, and particularly the confidence in the inflation forecast. So in the June projections, there were just one or two participants who had more than actual normal confidence in their projections. All the rest of them said more uncertainty than usual. So that's the confidence piece that I'll be looking for.
Betsy, do you think that it's appropriate for this Federal Reserve to be so disproportionately weighted to cutting rates at a time where we're not seeing true weakness in the labor market?
Well, cutting rates is right now only reducing the amount of tightness. It's not in any way becoming stimulative. And so I think it is appropriate to begin that, but I think they'll go fairly slowly and feel their way along. The one piece that I don't think there's consensus on is what is the level of neutral? What is the neutral level of interest rates, those that are neither stimulative nor restrictive? And I think they'll be feeling their way along to that point.
They also didn't really resolve the other issue, which was the theme of the whole conference, which was how much was monetary policy responsible for bringing down inflation and how much could it be responsible for preventing some sort of downside to the labor market in general. I mean, did we get any answers to some of the bigger questions other than simply a Fed show came out and said, yes, we're going to cut rates, we're going to start the process, and we could potentially cut a lot?
So actually, I think he did address that question. The piece that he talked about is the importance of inflation expectations. And what I heard him say was, yes, we were wrong on transitory. Once we realized we were wrong, we acted. And so what I heard from that is, so the Fed might get the individual settings wrong from time to time, but its commitment to its mandate and willingness to act in furtherance of that mandate is most important for the confidence and anchoring inflation expectations. And that piece, I think he declared victory on, not necessarily inflation, but inflation expectations remaining anchored through this cycle of inflation.
Can we deal with inflation, their contribution to actually bringing inflation down from 8 down towards 3? Betsy, what's your impression of things? Because in that speech on Friday, I think we certainly walked away with this idea that the Federal Reserve Chair was acknowledging that a lot of the work came from elsewhere.
Well, this was a supply side driven inflation anyway. So all of the work was on the supply side, which the Fed can't really affect. All the Fed could do was hold demand in check as best it could while supply caught up. And that's true for the labor market as well as the goods market. And I think they did that. But I heard in his speech, he recognized that the reduction in inflation has come entirely from supply, including on the labor side. So when you look at labor, I don't think we have a weak labor market. It's coming into balance, but it's coming into balance because of improvements in participation and increases in immigration, both of which have a limit to how much they can continue to contribute.
Betsy Duke, appreciate it. Thank you. Former Fed Governor Betsy Duke there on the latest, and the reaction there to that speech begs the question. Further improvements on inflation from here? Does it require the pain that the Federal Reserve Chairman was talking about 2 years ago? And is he willing to allow that pain to actually emerge based on what we just heard on Friday?
Well, based on what he said Friday, no, he's not. He is not worried about the labor markets. It's too robust. Quite the opposite. He's worried about further deterioration, that would not be welcome. What she just said there was fascinating. Declaring victory on inflation expectations, not necessarily inflation, but that their role in bringing down inflation expectations was creating the price stability that they're heading out for. This explains why the University of Michigan survey takes on renewed importance. If this is truly their metric, they're looking at what the 500 people who are surveyed for the University of Michigan survey, believe that inflation over the next 1, 3, and 10 years is actually going to be, might be the most important kind of information for them to look at.
Are you looking forward to leaving behind this period of monetary policy?
Well, I'm looking forward to the history books being written about it so that we can more fully understand it, because right now I would say the chapter is not over.
It's almost as tedious as that long period of zero interest rates. The obsession over, you Mitch.
Okay, but what this highlights to me is how little we really understand so much of this. We don't understand whether we're in a new inflationary regime. We don't have agreement on what the new neutral rate is. We don't understand what the excess is that were built up over the zero rate policies, whether they have to be unwound in any kind of disorderly fashion given the refinancing wave. There's so many questions left over from the zero interest rate period of time. There are a lot of things that are going to be very interesting that will be written, but that just sort of feel like morass right now.
If you really want to liven things up, stir the pot, so to speak, read Adam Posen's piece in the Financial Times going into the weekend. He thinks the Fed should prepare the market and this economy for the pivot to the pivot, that the chairman should reiterate the stagflationary effects of mass deportation and point out the vast majority of tariffs are paid for by US purchasers and therefore will stoke inflation, rather than simply hoping the factors that would drive a reversal in policy will not arise. The Fed needs to start laying the groundwork for a possible pivot now. Adam Posen, this is controversial, I know, not everyone will agree with this, but Adam believes that if Trump wins the election and does the things that he's saying, the Fed's going to be hiking next year.
The Fed's channeling Shogun. Today is today, yesterday is yesterday, tomorrow is tomorrow.
I've been watching Shogun.
It's so good.
Isn't it the best?
It's really a fantastic show.
I won't ruin it for you, because I know you're sort of
yeah.
mid-season, but fantastic. Third hour of Bloomberg Surveillance up next. Sonders of Charles Schwab, Pierre Ferragu of New Street, Matt Luzzetti of Deutsche Bank, Mike Collins of PGIM.
The time has come for policy to adjust.
We're more vulnerable to another negative data point on the labor market.
There's no question that growth is slowing, the labor market's slowing.
People have moved violently in terms of the narrative of the economy, in terms of what the Fed should do.
They really need to get a move on. I wish they'd started earlier.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Big shake-up in the stock market. The rally continues this Monday morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now with equity futures up 0.1% on the S&P. The outperformance this morning, where the outperformance was on Friday in the small caps, the Russell ripping by another 0.8%. We've been through the week ahead a few times. Let's do it again. We've picked out these two key events, two dates, Wednesday and Thursday. NVIDIA earnings Wednesday afternoon, Thursday morning, 8:30 Eastern Time. Jobless claims with so much weight now, Lisa, put on labour market data.
At what point is bad news good news? And I hate to bring this back, but here you go, because there is this issue of good news is good news because the Fed's going to cut rates, and bad news could be good news because the Fed will cut rates even more aggressively. That is basically the dynamic that Fed Chair Powell seemed to put out there on Friday when he said the time has come. And basically that was an all clear to market saying the Fed has your back.
Heads I win, tails you lose. Sort of win-win for everyone now.
At least for now. And we're going to keep asking people, and people are going to try to dodge it as they have this morning about what the number is where suddenly bad news becomes bad news. But in the meantime, they can just explain that there is going to be some sort of Fed put. And otherwise, there is not any negativity really baked into the data that they've seen as of yet.
You'll hear lots about September 6th and very little about September 11th. CPI's on September 11th. That used to be like the data point for this market. And now it's payrolls data on September 6th. In our survey, and the estimates will keep coming in, and this median estimate will move around. But the median estimate right now, 160. I think this market would take a 160 and run with it.
You know, one thing that we really haven't explored is it seems like the Fed is seeing signs of weakening that have them very concerned. Austin Goolsbee talking about that in a more sort of dramatic way than some of the other Fed officials. And yet people come on the show say that they don't see it. We're not hearing that in the commentary from companies, even retailers who are saying that actually they are seeing ongoing retail spending and they're keeping people employed. So which is it? What is it that the Fed is seeing that other people in the market are not? And that, to me, I think is something, a delta that we have to explore, because that is what's been supporting equity rallies at a time when the Fed is talking about weakness that they need to get ahead of.
When you say the Fed, you talking about Chairman Powell or other members of the committee? We had this conversation in the last hour. When the chairman spoke on Friday, was he speaking for himself or was he speaking for the committee? Betsy, former Fed governor, was on the programme just moments ago, and she said almost for the entirety of that speech, he's speaking for the committee until he talked about confidence levels around inflation, and he talked about my confidence around inflation. How much space will there be for debate come September 18th?
It seems like they've dodged the discussion around what the neutral rate is and how much inflation is going to come down. I will just put this out there, that no Fed official has dissented at a policy meeting since June of 2022. That matches the longest streak of consensus types of reads going back to the period between 2003 and 2005. Do we start to see fissures in that, given the fact that we do have dissent? At what point do we get to that level, given the fact that at this point, sure, a lot of people could agree, yes, you should bring down interest rates just based on how much inflation has come down?
Some healthy dissent. You'd welcome that, wouldn't you? I'd welcome that too.
We're starting to hear it around the margins, but what's the point of getting consensus if there truly is a difference in opinion? Healthy debate is healthy.
We'll take some healthy debate. Some healthy dissent. Your equity market on the S&P 500 positive by 0.1%. A little bit of a lift here. In the bond market, yields higher by not even a basis point. 380.84. There's a rally in crude, run by 2.8%. Lisa's been pouring over some of the details out of Libya. Lisa, WTI 76.95. Brent crude up by almost 3% as well.
Yeah, so basically there's a rival government in Libya that's trying to kick out the central bank governor. And in response, the central bank governor in the eastern government said it will shut down all oil production and exports. This was what led to the trigger that we saw, where oil prices were higher coming into the session, but went even higher still. And it just highlights how it's not just about what's going on with Israel and Lebanon and Iran, but also in the broader region. I will just add to this that you could question whether that lift in oil prices to start the session had to do more with what was going on with Israel and Lebanon, Hezbollah, or whether it had more to do with the fact that Russia bombed Ukraine's energy sources. So there's a lot going on here under the hood that's making things complicated, not just for oil traders, but also for the central bankers to the oil world, which is Saudi Arabia.
It's very difficult to keep up with. Brent crude 81.11, WTI 76.88. Coming up this hour, we'll speak to Sonders at Schwab as stocks rally on a Powell pivot. Pierre Ferragu of New Street Research as investors await Nvidia earnings on Wednesday, and Matt Luzzetti of Deutsche Bank on why the labour market will dictate the size of rate cuts. We begin with the big issue. Countdown to a cut. Stocks rallying as Fed Chair Jay Powell gives markets his clearest sign yet that September is on the table. Sonders at Schwab saying the following. Powell's speech was not a surprise, but markets rallied on cementing a start to the rate-cutting cycle. The labour market is more clearly in focus now for the Fed, with the view expressed at Jackson Hole that the Fed doesn't see the need for any further labour market weakening. Lizanne joins us for more. Lizanne, wonderful to start Mondays with you. Thanks for being with us. Any cause for concern whatsoever around this Powell pivot? Because certainly the overwhelming majority of people on this programme this morning don't have much concern.
No, I don't have much concern, but I would say, and I know you've all been talking about it throughout the course of the morning, be careful what you wish for if you're hoping for an aggressive cutting cycle on the part of the Fed. Because if you look at, and there's a long history in terms of years, but there's only 14 full Fed cycles over history. That's a pretty small sample size, and you have a really wide range of performance in terms of what the market has done in the aftermath of the initial cut. But where things are a bit clearer is if you contrast fast cutting cycles with slow cutting cycles. And the maximum drawdown is twice as large within a year following the initial cut in fast cutting cycles versus slow cutting cycles. So you actually want a Fed that is eyeing the escalator down, not the elevator down. And I think that gets lost in some of this debate.
We've heard people say, I'm sure you have as well, Liz, that the Fed puts back, Lizanne. The Fed's put back and everything's going to be OK, no matter how bad the data might be. Lisa mentioned this, Lizanne. I think we need to build on it a little bit more as well. How the market would respond to bad data. We've been told good news is good news and bad news is bad news. Do you think even then, after what we heard from the chairman on Friday, bad news still really is bad news?
Well, particularly if it's really bad news. If we were to see a significant weakening from what we've already seen within the labor market, yes, you'd get that reaction function on the part of the Fed, but I'm not sure risk assets would have a sustainable rally associated with that. So I think that's the calculus at this point, is the level of weaker than expected data and what it generates in terms of expectations for the Fed.
Lizanne, everyone's going to hate this question. I'm sure you will too, but I'm going to ask it anyway. What is that trigger for a jobs market that means this is truly bad news?
That's a good question. I don't know if it's one data point, although I think if you get the next labor report next week and across the metrics that we're all focused on, not just the headlines of payrolls, but what the household survey says, what the revisions are to the prior 2 months, if you see it in terms of hours worked, long-term unemployment, the differential between temporary and permanent, I think it would have to be something where the weakness was pretty robust within the data versus just a headline being weaker. And I wanted to go back to the first part of John's question earlier. This sort of wraps a bow around this in terms of, is the Fed put still alive? I think the Fed put is still alive as it relates to economic data. There was a time there where the Fed put was applicable to really weak equity markets or turmoil in the equity markets. I think Powell's been pretty clear that their mandate, part of their dual mandate, is not keeping volatility suppressed in the equity market. So I think that Fed put is dead. I think it's still very much alive, but we need to have it in the context of economic data, not market volatility.
Although the distinction between the two is getting more and more complicated, especially as they talk about how any downside risk to the labor market could be negative at a time where a lot of people look at financial conditions as a key input. I mean, at what point are we looking at a Federal Reserve that is not going to tolerate some sort of significant sell-off simply because it could weaken that outlook for the labor market?
Well, I guess here's a scenario where I think the Fed put would not apply to markets. If we were to actually get robust data, both on the inflation side of things and not a weakening in the labor market, and it changed the calculus to the Fed maybe having to even consider not moving in September. That could cause some turmoil in the equity market. That would not be a trigger for the Fed to step in and say, ignore the better economic data, ignore the uptick again in inflation. We're going to tackle weakness in the equity market here by continuing to loosen policy. And Lisa, your point is also very good about financial conditions. It was very, very brief, but we saw a pretty big tightening in financial conditions when we had that early August turmoil. But that kind of turned on a dime and went back to slightly looser, which is another reason why our view is the Fed's going to start with 25, and their bias is to stick with that, and only with more significant weakness in the economy would they consider bumping that up to 50.
What do you think is going to be more important this week, Lizanne? Do you think it's going to be jobless claims, or do you think it's going to be NVIDIA?
Tell me what NVIDIA's report is. I think if NVIDIA is in line, it may not be a big needle mover, but I think you could see a needle mover for the market that particular day, both with an outside surprise on the upside or the downside. Claims is important, but I think the next monthly jobs report maybe exceeds the importance of claims, unless we see a really big outlier number within claims. And then, of course, we've got core PCE too. That doesn't tend to surprise significantly around expectations, because once you have CPI and PPI in the books, you can kind of map it to what PCE is going to be.
Lizanne, we'd love your thoughts as well on leadership. Small caps outperforming again today. Saw that on Friday. Saw a series of all-time highs on the equal weight on the S&P 500 last week as well. What's your take on leadership at the moment, and what are you telling clients?
So, yes, you've seen a bit under equal weight, under small caps, but I think you want to fade anything lower quality within small caps and lean into higher quality. Still a huge differential in terms of the performance within an index like the Russell 2000 between, say, non-zombie companies and zombie companies, about a 17 percentage point difference in the performance there, with maybe obviously the non-zombies outperforming. You look at profitability as a factor. That's been a dominant factor within large cap indexes, but also within small cap indexes. So I think you want to, if you're looking for opportunities down the cap spectrum, don't sacrifice the fundamentals, especially around things like profitability and avoiding those zombie companies.
Lizanne, one of the very best. Appreciate it as always. Lizanne Sonders there of Charles Schwab, with the small caps up by 0.9% today. The S&P 500 up by about 0.1. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Kamala Harris' campaign raised $82 million during the Democratic convention. That pushes the campaign's haul to $540 million since Joe Biden announced he was stepping aside. A third of those who contributed were first-time donors, and 2/3 were women. Meanwhile, the top 10 super PACs supporting Trump have collectively raised approximately $305 million since the beginning of the year. Meanwhile, dual hurricanes are threatening Hawaii. It's a rare combination that could bring heavy rain and winds to the islands twice within 1 week. Hurricane Hone passed south of the Big Island on Sunday with sustained winds of 80 miles per hour. Another named storm, which is currently a major hurricane, could impact the islands in the coming days. And new Boeing CEO Kelly Ortberg faces questions over the future of its Starliner program after NASA turned to SpaceX to return astronauts stuck on the International Space Station. NASA announced the decision after weeks of testing and debate over Boeing's faulty spacecraft. It's the latest blow for Boeing in a year that's also included a cabin blowout, federal investigations, and an executive shakeup. That's your Bloomberg Brief. John?
Brutal times, brutal stuff over at Birmingham. Yahara, thank you. More from Yahara in about 30 minutes. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Pierre Ferragu of New Street Research as investors look ahead to NVIDIA earnings on Wednesday. From New York, this is Bloomberg. The opening bout 1 hour and 14 minutes away. Equity futures up by 0.15%. In the bond market, yields going nowhere. Your 10-year 380.65. Let's get you some morning calls. First up, Telsey Advisory Group cutting its price target on Lululemon to 360 from 470. The analyst Dana Telsey expecting a weaker second half due to increased competition, a challenging backdrop in China, and Lisa's given up shopping there.
Well,
their stock is up by 0.5%.
There are competitors, Worry, for example.
I have become an unofficial Vuori brand ambassador.
It's fantastic. I have to be honest.
The best.
Okay, but this is going to turn bad, so let's move on.
Is it already?
I think it already
It's
has.
going to turn bad. Okay. Stock is up by 0.5%. We're moving on, apparently. Lisa's rules. Next up, Bed raising its price target on Foot Locker to 35, maintaining a neutral rating. The firm anticipating inline results when the retailer reports on Wednesday, but seeing several potential headwinds for profit upside. Their stock is up by 2.75%. And finally, your third call, Stifel, lowering its price target on Nike to 79, keeping a hold rating. The analyst saying Nike's back-to-school athletic footwear survey suggests competitive pressures in the US market. The stock Lisa down 0.9.
Yeah, they've missed out. I'm sorry. This has been sort of the issue for both Nike and Adidas, where they're talking about how do they compete with the Hokas of the world or OCs of the world. I mean, they basically have lost some of the clout in the running world, in the athletic world. And so now they're trying to renew their cool at a time where there are all these upstart companies that are targeting the Air Jordans that really were popular, say, 5 years ago.
Had we talked about Vuori before? Was that the first time?
I think that was the
That's
first time.
amazing. On the same page about that. Yeah. I was there
I'm
Saturday morning.
Really?
Yeah, fantastic.
It's really high quality. I like the style. It's sort of
Really
like
soft
low
fabrics.
stated.
Yeah.
It's very
Totally on board. We'll continue this. When this wraps up, we'll continue this. Good stuff, Bramo.
Yeah.
Nice. All right. Turning to tech. All eyes on Nvidia. Earnings on Wednesday. The last of the Magnificent Seven to report. Shares this month up more than 10%. Analyst Pierre Ferragu of New Street Research recently raising its price target on the AI giant to 148, expecting reassuring signals in the earnings results. Their stock is up by about 0.5% this morning after a decent rally on Friday. Pierre Ferragu of New Street joins us now for more. Pierre, just go through sort of base case expectations for you and the team coming on Wednesday.
Yeah, so on Wednesday, investors got shook off a bit by all this noise about the Blackwell family of chips, the next generation chips being delayed. And so that created some kind of like nervousness around the stock. And to us, the reality is that NVIDIA is still in the same situation. All buyers are increasing their capex. The supply chain is increasing capacity very, very steadily. So it's very reasonable to expect NVIDIA to do better than what they guided 3 months ago and to guide for the next 3 months in the same vein, like above current expectations. So we think the numbers are going to do fine. And then the second thing is all investors are going to ask on the conference call about the Blackwell delays. What does that mean? Does that mean like growth is going to slow down? And our view here is kind of like counterintuitive. The reality is that when you launch a new chip like Blackwell, it's consuming more of your supply capacity. You need more HBM chips per GPU. You need more like CoWoS packaging capacity per GPU. And so if the new chip is ramping slower, it's actually easing up capacity constraints. And so what we think is that the management is going to explain on Wednesday that while Blackwell might be delayed by 6 to 8 or maybe 12 weeks, Hopper, the previous generation of chips, is actually going to continue to sell very well because we're still in a world in which many, many, many people, many teams want to have as many GPUs ASAP. And so if the next generation is not ready yet, they'll keep buying a lot, as much as they can, of the previous generation.
Pierre, I wanted to ask you a few questions that I don't think will be answered on the call on Wednesday, and it's what's happening further downstream. I had this conversation last week with Bloomberg's Mandeep Singh, and he built things out for us a little bit as well, and I'd love your thoughts too. When you hear from their biggest customers, they are still bulled up on investing in this cycle big time, without a doubt. You just get the sense, though, that investors just on around the edges might be losing patience with the story, that they actually want to start to see that investment turn into real bottom line profit growth. Pierre, do you identify any kinds of investor restlessness further downstream with the end use case for AI?
Yeah, I think you're spot on. That's becoming like the key question, the key concern for investors. And that's the right way to look at it. So we're doing our best tracking down, who's doing what with AI. And so far, we think signals are extremely positive. Like you look at what Facebook can produce in terms of numbers of efficiency gains driven by the migration of their recommendation engines on larger systems. When you hear like companies like Walmart telling about how much efficiency gains they gain from AI, I think we're still in a phase where people are getting excited about it, and we are in that kind of like almost like contradictory situation where today, if you don't invest in AI, whether you are like a Walmart using it or like an Amazon or a Google deploying the infrastructure, you're taking big risks because AI is very, very powerful and evolving very, very, very fast. So I think we're fairly safe in terms of the news flow coming in. But there is another reality, which is that we are getting into 2025 into a world that is going to spend like $150 billion on AI chips. And the key question is going to become, again, well, what's next? Can NVIDIA's business grow significantly from there again? But we're not going to have any visibility on that for at least, the next 6 to 9 months.
Pierre, do we have any visibility into what the policy backdrop is going to be and how that might affect NVIDIA? And I say this as there's a front page story in the Wall Street Journal today talking about how Chinese AI developers are basically working with internet brokers to access NVIDIA chips overseas so that they can work on them without violating some of the bans on importing some NVIDIA chips into mainland China. I mean, how much do you sort of look at this and see this as something that could potentially be a liability for the company that they talk about going forward?
Yeah, I think it's always an overhang. The government can do whatever they want. The invisible hand is still pushing GPUs towards China, and Chinese users are actually still accessing their GPUs. The government has to work on a thin line. It's very, very challenging. They want to keep the leadership in AI in the US, and for that they don't want to weaken NVIDIA or any players, and they want to make sure they don't let China catch up in terms of AI capabilities. I think this balancing act is going to continue. We've seen it over the last 2-3 years, and you have back and forth, and you might have like a tightening of regulation around NVIDIA. But now, at the end of the day, it's a smaller moving part. Remember, we are still in a world in which people want way more GPUs and way more chips than what is being produced. So if you have a ruling, limiting again access for China to leading GPUs, China will instantly buy, previous generation GPUs, less powerful GPUs. And then the more powerful GPUs, and maybe we had in our models that we're going to China next year, they're going to go to Western clients. And, I would call that a second order moving part. It might create a lot of headlines, but I don't think it's enough to disrupt the trajectory as long as we are supply constrained globally.
Pierre, thank you, sir, for your clarity as always. Pierre Ferragu there of New Street Research. Looking ahead to numbers from NVIDIA Wednesday afternoon. The most important quote ahead of these results came from Sundar Pichai of Alphabet, who basically said the biggest risk here is underinvesting. That's one of their biggest customers, saying they want to overinvest and not underinvest because the biggest risk is underinvesting. When investors start to lose patience with that, that's when this story changes sometime sooner. At least that's one reason for it to change. Don't see that just yet.
That's the reason why there's so much optimism. You're not hearing that at all from companies, and the companies are pushing back and say, hey, investors, you can be skeptical of our expenditures, but we're going to keep on doing it. So far, this is a company that has not missed estimates in the past 7 quarters, and I would argue in those 7 quarters have blown away expectations and the upside revisions to estimates over the remainder of the year. That's what a lot of people are expecting this week as well.
As the bar has got higher and higher, it's just sort of been beat and raised, beat and raised, beat and raised.
So options are seeing a 9.4% move post-earnings. We're talking about a company that has a massive valuation. We're talking about huge swings in just market capitalization value.
Slightly higher in the pre-market this morning. Equity futures up by 0.1%. Up next on the programme, Matt Luzzetti of Deutsche Bank, and we'll speak to Michael Collins of PGIM Fixed Income. A view on the economy, a view on the market, just around the corner. Stocks on the S&P 60 minutes out from the opening bell, firmer here by 0.1%. We've noted the outperformance in the small caps over the last week. It continues up by 0.8% on a Russell. Switch out the board, turn the page and get to the bond market. Big move lower last week at the front end of the curve, at the back end of the week, following remarks from Fed Chair Jay Powell. Yields aggressively lower, down not even a half a basis point this morning. 3 91. Not too far away from where we've been pretty anchored so far over the last few weeks, Lisa, which is just in and around 4%.
Okay, to be very honest, very little drama this morning. These are very minor moves. At the same time, I do think it's interesting that the slight pop in oil prices is actually coming with longer-term yields popping just a touch on the margins. And again, this sort of, what kind of are we not watching out there? Is there a risk to longer-term yields and longer-term inflation expectations, the more biased the Fed is to just cutting rates in response to any potential economic weakness?
So turn to crude and look at WTI and Brent. When you see a move like this morning, your first question you've got, is this a demand-side story or a supply-side story? This move today, Lisa, we can all agree, is a supply-side story.
Given the fact that Libya is, particularly the eastern government, is curtailing or completely stopping their production and exports of crude, this is in response to a domestic squabble in terms of kicking out the central bank governor in the eastern government region. It just highlights how vulnerable this whole sector is to a whole host of potentially volatile areas. It's not just that. It's also Russia attacking Ukraine's energy supply. So there's a lot going on that goes beyond just what's going on with Israel and Hezbollah and Iran.
Crude is up by 2.7%. Under surveillance this morning, some top stories for you. Apple sets its sights on a September launch date. Sources telling Bloomberg the tech giant is planning to unveil its latest iPhones, watches and AirPods on September 10th, a critical launch after several quarters of sluggish sales as it looks to stay competitive on AI. That's the big date, September 10th.
It's a big day on many reasons. I mean, it's also going to be the debate, evidently, supposedly, on ABC between the two presidential candidates.
Possibly,
depending on whether that actually gets done. Look, the big question for them is, can they come up with some sort of super cycle in terms of replacing iPhones if there is some introduction of artificial intelligence in a concrete way? The true metric of that, I have been told, is a one John Farrow index about whether Jonathan Farrow will actually go to the Apple store and turn his in because he sees the other one as preferable.
I went to the store and turned some old ones in.
Ooh.
Spent a long time at the Genius Bar and they were incredibly helpful. Since we're doing reviews this morning, they were incredibly helpful.
All right. Joe, thank you for being nice to him.
Very, very easy to take stuff back. Super easy. And they explained to me how they recycle the phones. They put it in this machine. It just goes and just like that. Just like that. Just like that.
But does this make you actually want to get a new phone?
I'm considering. We'll see. We'll see what the new one looks like.
This is bullish on the super cycle.
We'll see what the new one looks like.
Okay.
You know, will that AI stuff really change my life and help me multitask in a much more efficient way? Can I spend less time on the phone? I'll upgrade the phone to spend less time on it. Does that make sense?
Do you think that you're not going to be suspicious of what mechanically is going on to read your mind?
I'm already super suspicious of it.
Okay, but you're still okay with it?
I've never used Siri. Ever.
See, this is what I'm saying. Right, but you're still going to use AI because ultimately you've got to get with it or else it's going to leave you behind.
Potentially. We're getting deep here. That's how I feel, yeah. Okay. I feel like I'm being left behind, Bramo, by technology. That's how I feel.
All right, we'll analyze that more.
That's how I feel. I feel like I'm being left behind by technology every day and I resent it. I do resent it.
Okay, we can talk more about that later.
Let's turn to another story. White House National Security Advisor Jake Sullivan is heading to China from Tuesday through Thursday as the administration pushes to keep dialogue open. China is expected to bring up tariffs, export controls and issues related to Taiwan as part of potential discussions. China's potentially got another problem. Who's the next president of the United States? What does November bring?
It doesn't matter. I mean, we've been talking about how it's U.S. Tariffs, but we got reporting this morning, and Justin Trudeau is expected to give a press conference later this morning to talk about how Canada is planning to match what the U.S. is doing, hitting China with tariffs on electric vehicles and steel. This is a global type of effort. So how much does it sort of gain steam in a way that it is the same regardless of who gets elected president?
How much daylight is there between the two candidates? I think it's the rest of the world that needs to worry with regards to tariffs. It just feels like it's going to be a bargaining chip for Donald Trump, for the future president potentially of this country.
But this is exactly the point. How much of some of the policies he's putting out there is simply a bargaining chip versus actually being something that he plans to implement? And that is actually another debate. But this goes to the question of how much policy are we ever going to get ahead of an election? Or how much is it basically just, dog whistles to try to get people a sense of what they may or may not do to use as a bargaining chip later on that won't actually ever get passed into policy?
It's a bit of everything right now. And just to sort of go back to what Lisa was alluding to last time around, September 10th is meant to be the date also for the debate, but now there's a question mark about whether that debate's going to take place on ABC or whether Donald Trump's going to turn up or not.
He raised questions about it, saying that the reporters involved were biased and he didn't want to
You should
be involved.
watch that exchange and judge for yourself, OK? The power pivot in focus after the Fed chair And Jackson Hole and his remarks. Matt Luzzetti of Deutsche Bank saying this: the White House, or rather Powell's Jackson Hole speech, emphasized greater confidence on the path for inflation. He spent more time outlining risks of further unwanted deterioration in the labour market. Upcoming labour market and growth data will more likely determine the initial size and pace of policy easing. Matt joins us around the table. Matt, good morning to you.
Good morning.
September 6th. This question was always going to come your way, so forgive us for asking it directly with you sitting across us. How bad does that number need to be to make this 50? What are we talking here? 100, 125? What is it?
Yeah, so I had been of the view that it didn't really need to be all that bad for the Fed to go 50 basis points in September. Now, our base case is they go by 25 basis points, and that's because we expect that payrolls will bounce back, call it about 150,000 jobs, and that the unemployment rate could round down to 4.2%. But the expectation was that you needed to see a rebound in the data in order to allow the Fed to go 25 basis points, not 50. I think coming out of Friday, it kind of confirms that idea. That Powell's, the two lines that I would look at was them not wanting any more further weakening in the labor market data was important, and that they're willing to kind of step in and make sure that they ensure the soft landing at this point in time. So, if you were to put kind of numbers on it, I think if the unemployment rate ticks higher, that certainly increases the prospects of a 50 basis point move. If payrolls are below 100,000, similarly.
Were you surprised by the extent of the pivot? I'll just go through my expectations, and I think a lot of people shared this view. 2022, single mandate central bank focused on inflation. 2 years later, we were looking for balance. Mohamed El-Erian noted in the Financial Times, and I happen to agree with him, it feels like they're a single mandate central bank again. They're just focused on the different side of the mandate. Is that a fair characterization of the pivot?
So I don't know that they're completely on the labor market side, but very clearly, if you look over the past year, 2 years, it has been entirely focused on the inflation side. And I think importantly, they were seeking slower growth and a weaker labor market to help them get inflation down. It's very clear that that's no longer the case. So inflation data do matter, but I think in terms of the size of the moves, the timing of those moves, the labor market data is going to be most important.
What did you make of the fact that Jay Powell did not use the word gradual, methodical, any of the other sort of tea leaves that other Fed officials have used to try to indicate that they're not going to move quickly?
Yeah. I think this is one where context is really important. So when we wrote our preview note the week before, we didn't expect him to use language around gradual or methodical or patient or any of those language. We expect him to keep open the optionality for 25 versus 50, which is exactly what he did. However, we got the context over the previous days there where we had Harker and Collins and Bostic all using similar language. I think that built up a market expectation that he could also use that language. He didn't. So context, I think, matters there a lot. Really what he did is allowed the market to price some premium of 50 basis points, allows the Fed to be data dependent here, increased their optionality, and didn't want to lock them into a set 25 basis point move.
But just going back to John's point, this is exactly what's fueling beliefs that this is a single mandate Fed. Because essentially he's basically saying, the floor is the limit. We can cut as aggressively as we need to, even though we're not necessarily seeing weakness. We might see weakening, but not weakness. Do you think that there is a point at which Adam Posen's argument could come back into the fore where we could actually be looking at a reinflationary kind of environment where they have to focus more on that part of the mandate?
Look, I think the burden's on the inflation data right now. And what we've seen over the inflation data over the past several months is a lot of progress across all the key components that they would look at. There was an uptick in shelter inflation in the last print, but they have confidence that that's coming down. At the same time, you're right. You're not seeing outright weakness in the labor market data. But when you look at the broad swath of data, the quits rate is lower than it was in 2019. The hiring rate is incredibly low, as low as it was since 2014. The vacancy rate relative to the unemployment rate is back to where it was in 2019. The unemployment rate has risen 0.9%. We haven't seen layoffs pick up. But the question for the Fed is they're sitting at 5.3% on the Fed funds rate, well above what any view of neutral might be. Does it just make sense to start that process of cutting rates and to take out some insurance, I think, against the downside risk? I think that makes a lot of sense in this context.
Let's talk about estimates. The SEP, the Summary of Economic Projections, comes out on September 18th as well. I had this conversation with Betsy, the former Fed governor, a little bit earlier on. What kind of revisions are you expecting to those projections on September 18th? Just for instance, we've got unemployment year-end. They've got it at 4%. Year-end 24, 4.2, 2025, 4.1, 26. What are those numbers going to look like?
I think clearly the unemployment rate has to rise for this year. I think likely inflation comes down a bit, a tenth or two. And those two things together motivate what is likely to be at least 3 rate cuts in that dot plot for this year. I think, if the Fed is debating between 25 and 50 and they side towards 25 because the data is resilient, one area where they can give a little bit of a dovish signal to the market is dots further out, so 2025, 2026. Because what they had built into that June SEP was this very gradual process of cutting rates, almost this quarterly process of cutting rates. I think that notion is probably behind us. We are now of the view, or I think the market is the view, and the Fed is probably of the view, that they're going in 25 basis points each meeting, and it's really a debate between 25 and 50, really probably until they get closer to neutral.
Matt, this was great. Do we get dissent?
I think if they go by 25 basis points, no. I think if they were to move by larger, there's potential for dissent by somebody like Governor Bowman.
If you had to put Chairman Powell somewhere between 25 and 50, is he like leaning towards 50, a little bit more than 25?
I don't think so. I think there was an important message from the center of the committee last week, which is they would like to and prefer to be able to go at this more kind of meticulous pace, but they're going to be responding to the data.
Okay.
Now, for the market, it's created this difficulty because it's given them a sense that they're very data point dependent.
Are they not?
Well, the sense is certainly there. And the problem is that last data point is right before the blackout period. And it creates this potential for the market to move in a direction that the Fed might not want, heading into the blackout period, possibly opening up the potential for needed signals during that period.
Matt Luzzetti of Deutsche Bank. Hasn't stopped them before. To continue the conversation, Michael Collins of PGIM Fixed Income joins us now for more. Mike, did the Federal Reserve Chair just declare victory over inflation?
Yes. And I think it's the right thing to do. I mean, you're seeing, the actual data really punch lower, Jonathan. I mean, CPI, both headline and core, ex-housing, are printing below 2% now, year over year. And we all know housing has been a problem in the data. Housing is a lagging indicator. Home prices now in more and more metropolitan areas are falling. In certain parts of Florida, some of the higher end parts, home prices are down, Jonathan, 25% from a crazy peak. But you're definitely seeing that the housing part come down, and that's going to keep inflation closer to 2%. And the Fed has clearly, I haven't seen them pivot. A lot of people criticize the Fed of being too stalwart and sticking to their guns and being too slow to pivot. Man, they've pivoted a lot this cycle, right? From 0 to 5.5 when inflation was high. And they just did a major pivot from focusing on inflation to rightly focusing on weakness in the labor market.
There was a phrase we used to hear a lot of pre-pandemic. The Federal Reserve used to talk about extending the cycle, attempting to extend the cycle. I hear the same kind of thing all over again, Mike. As a market participant, do you operate with the underlying assumption that they can achieve that? They can extend the cycle?
They have the ammunition to do it, right? The question is do they have the guts to do it, right? What they should do is cut rates, start now. And I think they get that finally, right? And Powell is certainly on board to that. I mean, if they could snap their fingers right now, Jonathan, and not worry about financial conditions taking off in their face, they would probably put the funds rate at 3.5 today. I think that's probably the right level today, given the growth and inflation outlook. But that's not how they operate, right? They're going to move really slowly, methodically. I'm kind of discounting the probability of 50 basis point cuts at this point. I think they're going to move 25s until the markets force them or the data force them to move more aggressively. But the funds rate is arguably 200 basis points too high right now, but they're going to be really slow. And there's a chance that they have to play catch up at some point. That's normally how it works. But they have a lot of room to engineer the soft landing, right? So I think there's a really good chance they pull it off. And the economy, the private sector is not over levered, right? They're not over their skis like they have been in most long expansions. It's been kind of a short, post-COVID expansion here. And the companies and consumers and the financial sector and the housing sector are not levered, right? And that's really the most important point when we look at the economy from the bottom up, right? There's a real good possibility that we don't have a hard landing here.
And Michael, this seems like consensus, and that's what I really want to get to with you. Are we overpricing the chance of a soft landing, even if it is the most likely scenario? How much is that already a point that the market is leveraged to, given the fact that high yield spreads are some of the lowest that we've seen during the cycle, and that, frankly, all-in junk bond yields are the lowest that they've been in 2 years?
Yeah, it's funny, Lisa. The rates markets feel like they're pricing in maybe too high of a probability of a recession, right? I mean, right now, in 2 years from today, the markets are pricing in almost exactly a 3% funds rate. That's a lot. That's a lot of cuts. And I think what the markets are pricing in there in the rate structure is not that they get to 3, but that there's a good chance they get to 3.5 or 4. And there's this increasing probability that they have to cut into the 2s, right? So that's, I think, the probability distribution priced in. The credit markets, to your point, and arguably the equity markets, are kind of whistling past the graveyard here and really assuming that either you have a soft landing, or if you do have a recession, Lisa, it's a mild one and it's not an existential credit crisis where default rates spike, where you have a huge increase in bankruptcies. And frankly, that's really our view, that this could be one of those cycles, similar to maybe 2000, where financial assets reprice, but the actual real economy doesn't take a big hit. I mean, you had a lot of defaults then, but a lot of it was fraud related and other things. But I could definitely see a very benign default cycle over the next few years, even as the economy slows.
So, Michael, could you sort of put this through to understand what you're doing with this, kind of where you're leaning in, the balance of risks? What do you think is underpriced that you're going into, and what do you think is overpriced that on the margins you're trimming?
Yeah, I mean, it's actually pretty straightforward. It's almost frighteningly so. Like right now, I think there are just too many cuts priced in the near term, given the high probability of the softish landing, benign economic scenario. So we're fading the rally in rates here marginally, kind of underweight, that 5-year part of the curve, trying to, bet that the Fed isn't going to cut as aggressively as what's priced in right now. So that's one way to do it. And then on the credit side, you play defense, right? You hunker down, wait for opportunities like we saw 2 weeks ago or 3 weeks ago, where vol spiked. Spreads actually blew out pretty aggressively. That high yield spread you just quoted widened almost 100 basis points, right? Those are really big moves really quickly. It was difficult to execute on, but you want the dry powder, Lisa, to be able to capitalize on those bouts of volatility and on credit problems, even if they're just idiosyncratic problems. So be defensive in credit, but be aggressively willing to add risk when you have those opportunities, because remember, you have this Fed backstop that is potentially gigantic to support you if things do unravel more quickly.
Were you disappointed that there wasn't a clearer statement on the neutral rate or a clearer discussion even among the Fed officials?
No, they're as confused as we are on the neutral rate, Lisa. It's a moving target. It's really hard. Like, where is the funds rate supposed to be in a perfect world? They still have like 2 3/4 as their long-term dot. That is probably going to continue inching upward towards 3. Like I said, the market's pricing in 3 in just 2 years from now. The real funds rate, if inflation is at 2.5, should the real funds rate be 1 or 1/2? And maybe that puts the nominal rate at 3 or 3.5. Yeah, that sounds reasonable to me. I don't think the R-star is supposed to be 2, right? Which is where we are now. We're closer to 3 right now. Somewhere between 0 and 1 would be my guess. So, high 2s, low 3s on the long-term funds rate seems reasonable. I think the Fed is kind of coalescing around that view as well.
Mike, just before you go, what happened to the maturity wall in credit? We used to hear things like survive until 2025. I saw this quote from our team here at Bloomberg. It came from 24 Asset Management. It's less of a wall now. It might be a fence. Michael, just how low is it?
I was a high yield strategist 30 years ago, Jonathan, and we've always worried about the maturity wall. You never hit the wall, right? Companies, they change their behavior when conditions change, and people forget that, right? It's not a static environment. As rates have gone up, companies have been really actively and very aggressive in managing their balance sheets, paying down debt as it comes due, terming out their debt. And now with these rates structure lower, spreads really tight, as Lisa mentioned, now suddenly companies are looking at all-in yields 100, maybe even 200 basis points lower than they were at their peak a year or so ago. And they're like, heck, that's not terrible in a world where my revenues are growing in, mid, even high single digits, and my margins are hanging in there. Yeah, let's refinance our debt at these middle single digit coupons, for investment grade, and 7-handle coupons, if that. For high yield, it's not terrible. So they manage the wall and you never actually hit it. What causes defaults is people not being able to make a payment, an interest payment, as much as a principal payment. So don't, I think the maturity wall is overstated.
Mike, thank you, sir. Michael Collins there of PGIM. Appreciate the update. We've taken a lot of bricks out of that wall over the last few months.
So Bloomberg News put the story out over the weekend that the junk bond maturity wall records a historic collapse, that the pace of refinancing this year has been the fastest going back at least a decade. So it highlights how much people are trying to term this out. It always is this way. People worry about the maturity wall. I remember back in 2013, everyone was saying, it's it, this is it, it's over. Yeah. And then,
but this has happened without the Federal Reserve cutting interest rates.
Isn't
that the surprise here? How tight are we?
Well, it's a great question. And this also goes to the point of, have markets done the work for the Federal Reserve? And this is the reason why maybe they have the ability to go slowly, because the markets have gotten out front.
Already there. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Tensions escalating in the Middle East as Israel and Hezbollah exchanged fire over the weekend. More than 100 Israeli warplanes hit missile launchers in southern Lebanon Sunday. Hezbollah responded with a rocket and drone attack that killed one Israeli soldier with fallen debris. Israeli officials claim the strike prevented a massive assault planned by the Iran-backed militant group, and Israel has declared a 48-hour state of emergency. Meanwhile, Canada is imposing new tariffs on China, targeting electric vehicles, aluminum, and steel. That's according to people familiar with the matter. Canada will impose a 100% levy on EVs and 25% on steel and aluminum. Prime Minister Justin Trudeau is expected to unveil the policy in Nova Scotia, where he's gathered with his cabinet for a series of meetings about the economy and foreign relations. And the first ever Rolex Rainbow Daytona watch is getting ready to go up for auction in Geneva. Philips will auction the Rolex from the 1990s on November 8th. It's expected to sell for at least $3.5 million. The watch is believed to be the first ever to feature the now famous rainbow gem set pattern produced by the Swiss watchmaker, according to Philips. The watch has been in a private collection for almost 2 decades. That's your Bloomberg Brief. John?
Yahara, thank you. Does absolutely nothing for me. Nothing at all.
Rolex? Rainbow-colored Rolex?
Just that flashy stuff. Just nothing.
Where can people wear it? I mean, where do you go with this?
Not around here.
That's probably true.
See what's happening now?
Yeah, I do. But also, sort of, who are you trying to impress? I don't know. I'm speaking I'm preaching to the choir here.
Yeah, we're on the same page. Up next on the programme, we'll set you up for the week ahead. We'll get you some earnings, some data, and the calendar just around the corner. Devon and Bound just around the corner, 36 minutes away. Equities up by 0.1%, yields lower by a single basis point. One eye on crude all morning, up by more than 3%, 77.12. Look to Middle East tension and the latest in Libya as well. Let's get to the trading diary. The week ahead, the calendar looks like this at 2 p.m. Eastern. San Francisco Fed President Mary Daly speaking to Bloomberg's Mike McKee. Look out for that. Tomorrow, we'll get US consumer confidence data. Wednesday, NVIDIA reports after the closing bell. Plus, more Fed speak from Atlanta Fed President Raphael Bostic. Thursday, US GDP and another round of jobless claims on Friday. PCE and Lisa, you match sentiment.
All right, so here's my question. What's going to be the most important thing for this week, and potentially at a week when a lot of people are on vacation? How much did Peter Tchir set us up absolutely the correct way?
What did he say?
Where he was talking about algos, and he's talking about how there's, outsized volatility, and how much is it, again, going back to when the people are away, the algos will play. Is that going to be something where we start to see some really big moves in this week?
If you tell me what the earnings are for NVIDIA and what the data is for Thursday, I'll tell you what's more important data point, right?
Exactly. I mean, this is exactly the point, though. And you'll tell us, listen, if NVIDIA moves by more than 9%, akin to what the market is currently expecting, that's almost $300 billion of market cap that will be added or subtracted in one day. That is not insignificant.
Do you remember the record? $329 billion. That was the end of July. We've seen these swings before on this name. It's remarkable.
I was looking at a period. It's a 4-week period that sort of spans July and August. NVIDIA lost more than a quarter of its value. It has gained almost all of it back. It is about 5% away from its all-time high. These are massive swings that we could be dealing with in just a short period of time.
Long week ahead. Welcome back, Bramo.
Thank you.
It's good to see you.
Good to see you, too.
Empty seat here. She coming back?
I don't know.
Taking a week off?
Yeah. Evidently, she took Libby Cantrell's advice seriously.
Good for her. Come back after Labor Day weekend. Up tomorrow, This is your lineup. Chris Morangi of Gabelli Fund, Sebastian Page of T. Rowe Price, Matt Stokey of Northwestern Mutual, and Phil Camparelli of JP Morgan. From New York City, this is Bloomberg.